Good morning, students. Welcome you all once again in the live virtual classes organized by Board of Studies of ICAI. Friends, we started India 16 chapter, India 16 standard in the last class and will complete in today's class. As the name suggests, India 16 property, plant and equipment. We have covered what is the objective of this standard. We have covered what is the scope of this standard. And the three important aspects we have covered. Point number one, the definition of PP&E. And what is the definition of PP&E? Property, plant and equipment are tangible items which are held for what? Which are held for use in production or supply of goods and services or rental service or rental purposes or administrative purposes, right? And friends, these are expected to be used during more than 1 year. Okay, these are expected to be used during more than 1 year. So this is the definition of PP&E, and we have discussed there is one exception. And what is that exception? Which item, if kept for rental purpose, is not a PPE?
Land and building.
Land and building. If land and building is held for capital appreciation or rental purposes, then it will not be considered as a PPE. Otherwise, it will be considered as a PPE. Okay. Yes. So we did one case study also. Then we have covered what is the recognition criteria of PP&E, and we understood an item, an outflow will be capitalized as a PPE if it meet the recognition criteria. Okay. And what is the recognition criteria? Future economic benefits should be probable. Future economic benefits should be probable and cost can be measured reliably. Okay. So these are the two criteria. If these two criteria will be satisfied, then we can say that this outflow, this item has to be capitalized as a property, plant and equipment, and Ind AS 16 will be applicable in terms of accounting policy. Okay. Then we discussed that the spare parts, standby equipment and servicing equipment, if it meet the definition and recognition criteria of PPE, then it will be considered as a PPE. Otherwise, it will be considered as an inventory. Okay. Then friends, we discussed what is the recognition criteria for subsequent cost, right? So you have purchased a vehicle and you are capitalizing the vehicle, okay? Because it is giving you future economic benefit and it is giving you, and the cost can be measured reliably because cost is known. But what happens if after 6 years you are doing a major expense, not like every year service, not like small, that tire puncture repair and small repairs, cleaning, no. So you are incurring a major expenditure. For example, your engine has breakdown, right? Now you are replacing your engine. Now you are incurring a major overhaul cost, okay? Or you are incurring a major inspection cost because this inspection is part and parcel of continue that asset, right? It is a part and parcel of continuing that asset, right? For example, in aviation industry, it is part and parcel, it is a regulatory norm that every aircraft has to undergo with a major inspection. So what happens with these subsequent costs, whether these cost has to be charged to P&L or has to be capitalized? Standard says that for subsequent cost also, you need to apply the same recognition criteria, whether future economic benefit is probable and cost can be measured reliably. If answer is yes, then you will capitalize those subsequent costs, and those subsequent costs should not be day-to-day servicing, should not be normal labor, consumable, etc., etc. Those subsequent costs should be in the form of major replacement cost, major inspection and major overhaul cost. Okay, it has to be a significant component in comparison to the asset. It has to be a significant component. Okay, so then friends, the standard told that if these kind of major subsequent cost you are capitalizing, then you have to decapitalize the old component of such cost. For example, you are doing a major replacement, you are replacing one big part from that main asset, so that one big part which was already a part of that asset has to be derecognized, has to be removed. Okay, so friends, that is one. Okay, the second part is friends, all such component has to be derecognized and the new component has to be recognized, capitalized. And the second thing is, friends, so what happens if you are not aware about the value of the original part? Then standard says that you need to estimate that. And how do you estimate that? You can use the current cost to arrive at the original cost, right? So how you will arrive that? So for example, in the current period, in the current time, you spend 20 lakh rupees and you are replacing your engine after 6 years. So what was the value of 20 lakh 6 years ago, right? You will assume that value as the value of the component, and the remaining value, total asset value minus value of that component, the remaining value will be the value of the other than that component, okay? And friends, whatever depreciation you have charged, you will allocate the depreciation for the calculation purposes. You will allocate the depreciation in both the component, the one component and the other than the component of the asset, right? You will allocate that considering the same life which you have considered earlier. This is how you will get the carrying value of the derecognized part, or part to be derecognized, portion to be derecognized, and then you will derecognize that part and you will capitalize or recognize the new part. Okay, this is how this entire accounting has to happen. Then we discuss the meaning of cost, and we discuss that initially every property, plant and equipment has to be measured at cost. The cost component is equal to purchase price including import duties and non-refundable purchase taxes after deducting trade discount and rebates, plus directly attributable cost, plus initial estimate of the cost of dismantling and removing the item and restoring. Means, so what is your cost definition? Purchase price means the price which you are paying to the vendor, supplier, or the shopkeeper. Purchase price plus import duties if you are importing that asset, plus non-refundable purchase taxes. Means if you are paying some purchase taxes like GST, if it is refundable, if the input credit can be available, then you should not capitalize the GST. But if it is non-refundable, input credit will not be allowed. It will become part of the cost of the asset. Minus trade discount and rebates. If any trade discount is received, it has to be reduced from the value of the property, plant and equipment. Plus directly attributable cost means the cost would not be there if the asset would not be there. Directly attributable costs are those costs which are necessary for bringing the asset into the location and condition, right, for necessary for the purpose of intended use, plus initial estimate of the cost of dismantling and removing the item and restoring. For example, after 15 years, after 20 years, let's say you are removing and restoring that asset, so you need to capitalize the value of that asset. Okay, you need to capitalize the present value of that asset. So friends, this is what this slide is all about, right? What are the kind of the directly attributable cost we have discussed, and what is not a directly attributable cost, we have discussed this part as well, right? So friends, now quickly let's do a case study number 4, and this is kind of a case study which is there in your study material also. Okay, ABC Limited purchased. Any doubt from the first class? I have done the full revision of the last class. Any doubt from the first class or last class?
No,
No,
sir.
sir.
No doubt. Very good.
So
Yes.
how do we determine this discount rate in a real life?
So normally what happens, this discount rate is an incremental borrowing rate. For example, let's say the life of the asset is 10 years. Okay. And for example, I'm replacing my major component. Like we also did an example of illustration from ICAI Board of Study Material, turbine and machinery, right? So let's
Right.
say if I'm replacing my component after 6 years, what is the discount rate of 6 years, right? So we can use that. If I go to the bank and ask for a bank loan for 6 years, what is the rate of interest bank will charge to me? So that is an incremental borrowing rate. In real life, in practical life, the companies are taking a quotation from the banks. Okay.
Okay. Okay, sir.
Yeah. Yes. ABC Limited purchased furnace machinery for a gross price of rupees 200 crores. What is the purchase price?
200 crores.
200 crores. The seller granted 0.5% rebate, trade discount and rebates on the gross price of the machinery. What is the treatment of 0.5% rebate?
We have to reduce it, sir.
It has to be reduced. And what
Yes,
is the
sir.
value? 200 multiplied by 0.5%?
Sir,
1 crore.
1 crore. The gross price includes excise duty of rupees 20 crores for which input credit can be claimed by the company. And this 200 also includes 20 crore of excise duty, which is refundable, for which input credit can be claimed. What happened with this 20 crores?
it will
We have
also
It will reduce.
reduce it.
It will be reduced. So what is your purchase price plus import duty plus non-refundable taxes minus trade discount and rebates? What is the value of this paragraph?
Sir, 179.
179.
179.
200 minus 1 minus 20. 170. Then it also incurred rupees 15 crore as transportation cost, handling charges and insurance, rupees 5 crore for installation, 3 crore for testing and professional fee. What are these kind of costs?
To be included.
Why?
Attributable cost.
These are
Because
the
it is
directly
attributable cost,
attributable cost. Yes.
bringing into the condition and the location.
Yes, this is the directly attributable cost to be
Not
included.
the
What is the
cost.
total? 15 plus 5, 20 plus 3, 23 crores. 23 crores has to be added to the cost of the asset, right?
Yes, sir.
It has earned 0.2 crore. So they have done some trial run expenses, testing fee they have paid, testing expense they have incurred 3 crores. But when the trial run is happening, for example, a machinery or plant was installed, it was started, and there was a trial run happening. In the trial run, some goods and services were produced, right? And the company has earned 20 lakh rupees from selling goods produced out of testing, out of trial run expenses. In that case, tell me what is the treatment of this 20 lakh rupees?
We have reduced from the.
Other income, sir.
We have to reduce it from that testing expenses.
Yes, we have to reduce this from the testing expenses because I have incurred 3 crore rupees for testing and I got 20 lakh rupees. So net I have to capitalize. Okay, very good. The company borrowed 100 crores for financing the new purchase at the rate of 10%. Okay. So the company borrowed 100 crores. So the company spent 200 crores, but the company has borrowed 100 crores for financing the new purchase at the rate of 10%. The entire process of purchase to make the operation took 15 months. To make the operation took 15 months. The loan was outstanding during the period. The loan was outstanding during the period. Okay. So what is the treatment of this paragraph? What this paragraph indicates? You are a CA final students. So you have some idea. Tell me what is it is indicating.
Sir, this borrowing cost to be added to the cost of capital.
Interest, sir.
The borrowing cost will be added.
Interest on borrowing costs.
Yeah, Bibu, you want to say something?
Sir, it helps as qualifying assets, then it will be added, sir.
So you guys are talking about borrowing cost, right? Yes. Since the company has borrowed funds for the purpose of purchasing the capital asset, so this 100 crore multiply by 10%, multiply by 15, divide by 12. This will be your interest cost, right?
Yes.
Yes,
So
sir.
whatever borrowed funds are there for the qualifying period, for the qualifying asset, so that interest also needs to be capitalized. This is what you guys need to say. This is what you guys are saying, correct?
Yes, sir.
Okay, very good. And friends, the company has borrowed 100 crores, but the company has not spent 100 crores on a single day. So the company has done some temporary deposits for a shorter period of time in the bank, and the company has earned 10 lakh rupee, 0.1 crore from the short-term parking of the money borrowed pending payment to supplier and meeting all cost. So what is the treatment of this 10 lakh rupee?
Yeah, this will be reduced.
This will be reduced from where?
From the interest on borrowing cost.
Interest on borrowing cost. Interest is itself a borrowing cost. Yes. So this 10 lakh rupee has to be reduced from the borrowing cost, from the interest cost. Okay. And the net interest needs to be capitalized. Okay. Whatever is the temporary income we are earning out of the borrowing, so that temporary income has to be reduced from the borrowing cost, and you have to consider net borrowing cost. What should be the initial cost of the machinery? So we have solved this question, and let me show you the answer here as well. The 200 minus 1 minus 20, 15 plus 5 plus 3 minus 0.2, 12.5 is the calculation, 100 multiplied by 10%, multiply by 15 months, divide by 12, and this is 12.4. Okay, and the total comes out at 216.20. Whether the total is right?
Sir, total is 214.2, sir.
Yes,
214.20.
I also got to 1.4.
Yes. So the total is 214.20, right? Yes. So intentionally this total was kept at 216 to check whether the students are sleeping or they are awake, right? It's 214.20. Okay, guys? Yes.
Right.
Very good. Yeah. So friends, now we understood the cost. We understood it has to be initially measured at cost. Now we will discuss some different forms of purchases or different terms and condition, and what is the accounting treatment for that. Deferred payment creditor, right? So I went to buy a car and I went to the car dealer and I asked, what is the price of this car? The car dealer told that the price is 10 lakh rupees. Now, Chitra also went to buy that car. Chitra asked, what is the price of that car? And before that, Chitra told that, Mr. Dealer, I will pay you after 1 year. So that car dealer told Chitra that, madam, the price of the car is 11 lakh rupees. So he told me 10 lakh rupees and he told her 11 lakh rupees. Because she told him that, I will pay after 1 year. And he has given the price of 11 lakh rupees. Friends, what is the normal cash price? Friends, what is the cash price of this car? Tell me. If Chitra has to do the accounting, first of all, you tell me why he has told 1 lakh rupees extra to Chitra.
It's his profit.
Sorry?
Because of she is paying late.
Because she is paying late. Okay? Because she is paying late for deferred payment, he is kind of charging an interest. For example, if you don't have money to buy the car, you are taking a car loan. Right? On the day one, you are taking a car loan. There is a liability in the balance sheet. There is an asset in the balance sheet, right? But here, instead of taking a car loan, who is funding your car? The dealer is funding your car.
Yes, sir.
So technically speaking, dealer has given you a loan and dealer is giving you a car, and dealer has told that after 1 year, you have to repay me back the principal plus interest. Correct? Right? And how much loan the dealer is giving to Chitra? In substance, this all transaction is happening in substance. Dealer ने चित्रा को कितना लोन दिया? Chitra is saying 10 lakh rupee. Whether she is right or wrong? Guys, what's your answer? Is she right or wrong? Dealer has given a loan of rupees 10 lakh to Chitra on the day one, and
Yes,
she will
sir.
refund after 1 year. Yes, she is absolutely right. So you guys are confused between 11 lakh and 10 lakh. Dealer has given a car and a loan to Chitra on day one, and she will repay after 1 year. So on 10 lakh rupees, she is also paying a 10% interest, right? So after 1 year, she is repaying 11 lakh rupee along with the interest. Okay. So the difference between the 10 lakh and 11 lakh is, technically speaking, it's an interest difference. It's a finance cost, right? It's not a price of the asset. It's not a cost of the asset. So friends, standard says that if the asset is purchased at a deferred payment terms. Deferred payment terms means it is not a normal payment term, it is a deferred payment terms. Then what is the cost of the asset? The cost of an item of PPE is equivalent to the cash price equivalent. It is the cash price equivalent at the recognition date. At the recognition date. Cost of an item of PPE is the cash price equivalent at the recognition date. So at the recognition date, if Chitra would have paid the entire money, what amount she would require to pay? 10 lakh rupees. The dealer has told 10 lakh rupees to me also. So 10 lakh rupees the cash price equivalent. But if the in case payment is deferred beyond normal credit term, then what would have been the price? 11 lakh rupee. So this 1 lakh rupee is considered as an interest component. This will not be considered as a cost of the asset. This will be considered as an interest component, right? So friends, what is an interest component? What is a deferred payment credit? Standard says that the difference between the cash price equivalent and the total payment. What is the cash price equivalent?
10 lakh.
10 lakhs rupees.
And what is the total payment?
11 lakh.
lakh.
11 lakh. So the difference between this normal cash price and the total payment has to be recognized as interest, over the period of credit, unless such interest is capitalized as per Ind AS 23 borrowing cost standard. Okay. So have you got it?
Yes, sir.
Have you got this? So in case of deferred payment terms, what you need to do? In case of deferred payment term, you need to compute what is your normal cash price, what is your total payment, the difference should go to interest. Okay. Friends, now let's discuss illustration number 1 in case of deferred payment credit. Okay. On 1st April 2001, an item of property is offered for sale at 10 million. 10 million means 1 crore. With payment terms being 3 equal installments of 33, 33, 333 over a 2-year period. Payments are made on 1st April, 31st March and 31st March 20x3. So 1 crore is the value of the property which is given in this question. So 1 crore is not the value. It is written that 1 crore, at 1 crore it is offered for sale. Means 1 crore they are asking money. But this 1 crore is not upfront payment. This 1 crore is not upfront payment. What is this 1 crore? It is not upfront payment. This 1 crore is paid in 3 installments. The first installment on the day 1, which is 33, 33, 333, and the 2 installments at the end of first year and the second year. Okay. Implicit interest rate of 5.36% per annum is given. In the question, rate of interest is also given. Pass necessary journal entries for recording the property in accordance with Ind AS 16. Pass necessary journal entries for recording the property in accordance with Ind AS 16. What is the accounting entry? Tell me, in this question, how you will compute the cash price equivalent? Whether the cash price equivalent is 1 crore only?
No, sir.
No, sir. It's inclusive of interest component.
It is inclusive of interest component because it is a deferred payment. The first payment of 33 lakh is happening on day 1, but the remaining 67 lakh of payment is happening at the end of year 1 and year 2. Okay. So this is how it is happening. So friends, let's solve this question. Okay. Should I solve this question?
Yes, sir.
Friends, in case of deferred payment term, you can see what is your step number 1? Calculate the cash price equivalent. How will you compute the cash price equivalent? How will you compute that? Cash price equivalent. On 1st April, your payment is 33, 33, 333. What is the present value factor on the day 1 payment? 1. Okay, it is 1. So this is the value. On the day 2, on the second installment, after 1 year. So how you compute the present value factor? 1 divided by 1 plus 5.36%. This is the value. At the end of year 2, again, this divide by 5.36%. This is the value. Okay, right? So this is your 94, 99, 895. So rounded off, it will give you 95 lakh. It will give you 95 lakh, correct?
Yes, sir.
95 lakh rupees. And now step number 2, compute the interest component. Now you need to compute the interest component. What is your opening balance? 95 lakh, but you have paid upfront this much amount, 33. So your closing balance is this much. Now closing balance means balance on day 1, 1st April 1. Now on 31st March 2, your opening balance was this much. This is your interest rate, interest. This is your payment. This is your closing balance. This will become the opening balance, interest, payment, and closing balance. Any doubt up to this point? How we have done the computation? Any doubt?
Clear, sir.
No, sir.
Okay. What is the accounting entry? So PP has to be capitalized at the cash price equivalent. What is the accounting entry? PP account debit. PP account debit to bank. 33, 330. Why I have created the bank on the 1st April?
We have made payment.
We have made
Sir,
first installment. We have made
Yes,
payment.
sir.
We have made first installment. Okay. So PP account debit to bank, to creditors. Okay. Then on 31st March, you have to capitalize the interest. Capitalize the interest means you have to record the interest. Capitalize in the creditor account. So you need to debit interest and credit creditors. Okay. Then you need to pay the installment, creditors to bank. On 31st March 3, again you need to credit the interest to the creditors and debit to the P&L. And then you need to pay the money. Okay. So this is how your entire accounting has to happen. And what is your extract? Your PP is 95 lakh. Interest expense is 5 lakh. Your total payout is 1 crore. I hope this question is clear to all of you.
Yes, sir. It's clear.
Very much clear. Okay. So this is the solution which is given in the question. Right? These are the calculations. Now coming to the concept of exchange of asset. Friends, now let's come to the concept of exchange of asset. What is meant by exchange of asset? What is meant by exchange of asset? बताओ क्या मतलब होता है exchange of asset का?
Barter.
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 It's more like a barter. It's a barter. Okay. Exchange of asset is like a barter. For example, when I'm purchasing my asset on a cash basis. For example, when I'm purchasing my asset on a cash basis, okay, at what value I will capitalize my asset? At what value?
And the cash price, what we are giving?
What we are giving, what we are paying as a consideration, right? What we are paying as a consideration. This is what? The value at which I am paying the asset. The value at which I am paying the asset. The cash price which I am paying for the asset. Now, friends, if I am purchasing an asset and in return I am not paying in the form of a cash, I am paying in the form of an asset, then what is the value of the asset which I have purchased?
The
Batao.
asset we have received.
Sorry.
Fair value of the asset we have received.
Fair value of the asset we have
Received.
fair value of the asset we have received. Okay. Again,
Sir,
when you
sir,
are just a minute, Swaminathan. Again, when you are purchasing an asset, at what value you are measuring that asset? Again, my question is the consideration paid. In every standard, it talks about consideration paid. It is talking or not talking about consideration paid or consideration paid? Yeah.
yes, sir.
Yes.
So consideration paid means what you are paying. Why it is important? The same asset I am purchasing at 1 lakh rupees. Swaminathan is purchasing at 99,500 rupees because he has got more discount of 500 rupees. So the fair value of this asset is 1 lakh rupee, which me and Swaminathan both have received. But tell me why he is capitalizing at 99,500 and why I am capitalizing at 1 lakh rupee. Tell me. Because the standard says that the PPE has to be measured at cost. And what is the cost? Cost is the consideration which you are paying. Simple. Consideration which you are paying. Correct? And standard is saying if it is a deferred consideration, means you are paying in delay, then you have to identify a interest component, right? But to cut a long story short, if on the day one and this deferred payment concept will come into picture when you are paying in delay. But what happens if you are acquiring an asset today and you are paying today, then what is the cost of the asset? Tell me, what is the cost of the asset? Consideration paid. Consideration paid is the cost of the asset. Always remember what you are paying, that is the value. That is the value of the asset. So friends, in case of barter, again I am purchasing an asset, but instead of cash, what is the form in which I am paying? What is the form in which I am paying?
Asset.
Another
Asset
asset.
you are giving.
Here I am
In the
paying in
form
the
of
form
asset.
of another asset. I am paying in the form of another asset. So tell me, what is the value of the asset which I have purchased? At what value this asset is going to be capitalized, recognized?
Value of asset we have given.
Value of asset we have
Given.
given. The consideration we have paid. Consideration we have given. So what is the consideration we have given? We have given the asset. We have given the asset.
Asset.
That is the consideration we have given. That is the consideration we have given. So we have given the asset. Okay. So my dear friends, in case of barter, in case of exchange of asset, the first thing is you have to measure the asset on the basis of value of the consideration paid, value of the asset paid, right? So I again come back on this topic, and before that let me talk more on this. So what is the exchange of asset? It's a barter. It's a PP is acquired in exchange of non-monetary asset or a combination of monetary and non-monetary asset, right? So it could be only a barter and it could be a combination of barter and cash as well. For example, you are purchasing a car, and in return you are giving some furniture and you are giving some cash, right? For example, a building is purchased in exchange of Mercedes cars and 20 lakh rupees of cash. So it is a combination of monetary and non-monetary asset. For second example, a building is purchased in exchange of an aircraft. It's a non-monetary exchange. It's a non-monetary asset exchange, right? In case of exchange of asset, what will be the value of the acquired PPE, right? If the transaction does not have commercial substance, means the like transactions are exchanged, the like item are exchanged. For example, a person is purchasing a Maruti car and he is giving another Maruti car, right? So this is the like item, same item they are exchanging, right? So in this case, it will be considered that the transaction does not have a commercial substance. So in that case, asset acquired has to be recorded at the WDV of the asset given up. Means the value will not change. Only asset ID will change in fixed asset register, but the value will not change. But what happens if the asset have a commercial substance? So before that, example, A Limited purchased Maruti Wagon-R car in exchange of Maruti Swift car. The WDV of Maruti Swift in the books of A Limited is 5 lakh. What is the value of Maruti Wagon-R car? Batao. Batao, what
5
is the
lakhs.
value?
5 lakhs.
5 lakh. This transaction lacks commercial substance and hence the asset acquired should be recorded at WDV with the asset given up. But what happened? If the transaction has a commercial substance, right? You are purchasing a building and you are paying through what? You are purchasing a building but you are paying through an aircraft, paying through a car. Then the transaction is having a commercial substance. So in that case, you have to record the acquired asset as per below hierarchy. And what is that hierarchy? whether fair value of the asset given up or fair value of asset acquired. Fair value of the asset given up or fair value of the asset acquired. Whichever is identifiable. Whichever is identifiable. Friends, so in case only fair value of asset, only if fair value of asset acquired is identifiable, fair value of asset given up is not identifiable, then fair value of asset acquired. Okay. Or if the fair value of the asset given up is identifiable, but fair value of asset acquired is not identifiable, of course, fair value of asset given up. So first, in the question paper, whatever value is given, whether it is acquired or given up, you have to consider that value only. In practical life also, whichever value is practically identifiable, you can take that value. But what happens if both the values are given? What happens? In the question, the fair value of asset given up, which is consideration, and fair value of asset acquired, which is acquired, both are given, both are identifiable. Tell me, what is the value of PP acquired?
Asset given up, sir.
It's a given up. It's a given up. So if both the values are there, then you have to consider fair value of asset given up. If both the fair value are not clearly identifiable, then both the values are not given.
WDV of asset given up.
Yeah. WDV of the asset given up. ये तो होगा ना, because you are already having that asset. ये तो होगा ना. So
Yes,
let
sir.
me
Book
write the
में.
hierarchy. Let me write the hierarchy in this manner. I think then that will be more clearer, right? Then there will be more clearer. Let's see. If both the fair values are given, then fair value of the asset given up. Okay. If whatever fair value is identifiable, right? So both the fair values are not given. Only one fair value is given. So let me write here also. Both the fair values are given. Okay. ठीक है ना? Both the fair values are given. So only one fair value is given. Both the fair value are not given. Now you will get more clarity in your notes. Correct? Correct or not correct?
Yes, sir.
है ना?
Yes, sir.
This is your entire notes for exchange of assets. Okay. Any doubt? Any challenge? So friends, if the transaction does not have a commercial substance, then the asset acquired has to be recorded at the WDV of asset given up. If the transaction has a commercial substance and both the fair values are given, then you always need to take into consideration the consideration which you are paying, means value of the asset given up. Value of the asset given up. Okay. If only one fair value is given, then whatever fair value is given, you have to record at that value, right? If both the fair value are not clearly identifiable, then WDV of the asset given. Okay. Okay. Now let's do another illustration. Pluto Limited owns land and building. So this is already in their books of accounts, which are carried in the balance sheet at an aggregate carrying amount of 10 million. At what value this land and building is coming in the books of Pluto?
10 million.
10 million.
Means 1 crore. 10 million means 1 crore. Okay. And what is the market value, fair value of such land and building?
15 million.
1.5 crores.
1.5 crores, 15 million. So what is the difference between this carrying amount and fair value? What is the difference?
Sir, it include depreciation
50
from
lakhs.
carrying amount.
So carrying amount is the value which is recorded in the books of accounts at the value in which this land and building is getting carried. And what is the fair value? The fair value is the market value. Okay. It exchanges the land and building for a private jet. It exchanges the land and building for a private jet. Means it is paying, it is giving land and building, and it is acquiring private jet. Correct? And the fair value of the private jet is 20 million. So friends, fair value of the private jet is 20 million. Okay. So friends, what is the fair value of the asset given up? And what is the fair value of the asset acquired?
Sir, fair value of asset given up 15 lakh and asset 20 million.
So fair value of the asset acquired is 20 million and the fair value of the asset given up is 15 million. Okay. But it says that it also pays additional 3 million in cash. So whether this question only talks about exchange of asset or it also talks about exchange of asset plus cash.
Exchange of asset plus cash, sir.
Means
Asset given up.
combination. Means combination of monetary and non-monetary both, right? So friends, tell me, in purchasing this private jet, what this company is paying? This company is paying, there are two forms of payment. This company is paying in two ways. Number one, this company is paying in terms of land and building. Number two, this company is paying a cash. Correct? This company is paying a land in terms of land and building, and this company is paying a cash. Okay? Right? So, are you agree or not agree with me?
Yes, sir. Agreed,
Yes,
sir.
ये
Yes,
कंपनी
agree.
क्या क्या दे रही है? प्राइवेट जेट को खरीदने के बदले कंपनी क्या क्या पे कर रही है?
Land
लैंड एंड
and
बिल्डिंग दे
and
रही है
3
और
million
कैश दे रही
in
है.
cash.
Correct?
Yes, sir.
Land
Agreed,
and
sir.
building and cash. So friends, in this question, both the fair values are given. Fair value of asset given up and fair value of asset acquired. Which fair value will opt for recording this private jet?
Fair
Sir,
value of the asset given up.
Fair value of asset given up.
Sir, fair value of
What is the
asset
fair value
given
of
up
the asset given up? 15
15
million
million
plus
plus
cash.
cash
3
is given
million.
3 million total
So
18 lakh
total,
18 million.
so
18
total
million.
consideration is 18 million. So you will record your private jet PP account debit by what amount?
18 million.
18 million. So accounting entry, private jet PP account debit 18 million. To cash 3 million. What is
to
the next
asset
entry?
land and building.
What is the next
To
entry?
land
Can you please?
land and building 10 million.
Land and building 10 million.
To land and building 10 million or 15 million?
15 million.
15
10
million.
million starting amount plus
10
15.
million.
remaining amount
Sir,
balance profit alert.
Sir, but 10 million only will record because we are derecognizing the asset. So 10 million will be credited, and balance will go for what is that? Profit and loss account.
One of the portion of this question came in India's certificate course examination. So when you become a chartered accountant, institute also offers post-qualification courses, right? And there is one course which is certificate course on Ind AS, and I'm also faculty in certificate course on Ind AS and teaching chartered accountant also, means after you qualify. So right now you are in work in progress. So I'm also teaching WIP students and I'm also teaching finished goods student, right? And what are the finished goods student? Chartered accountant. So this question came in the exam of Ind AS certificate course. Majority of the chartered accountants had given the wrong answer. You know why? Because it's not about they are not aware. It's because, when you are in exam, you forgot the basic concept and you always run with the time, right? Always run. So you have cracked that, yes, 18 million is the cost of the asset acquired, and you have made an entry, private jet PP account debit 18 million, to cash 3 million, to land and building 15 million, right? So private jet 18 million is okay, to cash 3 million is okay, but when you credited land and building 15 million, that was not a carrying value, that was a market value. What is the value which is always in the books of accounts? Is it a carrying value? Is it the market value?
It's a carrying value.
Carrying value. So when you are crediting a asset, at what value you can credit your asset? You can credit your asset with a value which is there in the books of accounts, right?
Yes, sir.
So what is the value in the books of accounts?
It's
10
10
10
million.
million in this case.
10 million, but the market value is 15 million, and when you are paying a consideration, you are just break this transaction in a way. Break this transaction. So technically speaking, you have sold this asset. You have sold this asset at 15 million. Yes or no? This is a two transaction. One, purchase of private jet and sale of land and building. Can I say that?
Yes, sir.
So the 10 million value of land and building, at what value you have sold? 15 million.
15 million.
15
तो
million.
आपको क्या हुआ? आपको 10 की चीज 15 की बेची तो प्रॉफिट हुआ ना?
Profit, yes, sir.
Yeah. So 5 million is the two profit on sale of building, profit on exchange of building. 5 million is the profit. Okay. So think, whenever you are in doubt, break the transaction. ये हमने बचपन से पढ़ा है ना. So my daughter is in class 7th, and when she is solving the sums, any sum, you know what guidance I used to provide her, that beta, break the question into parts, then you will be able to solve. This is what we are doing in CA exams also, right? There are two benefit of breaking the question. There are two benefit of breaking the problems, and it is good for real life also. When you always run with a big problem, you will be in a big problem. When you run with a big problem, you will always be in a big problem. But when you break the problem into parts, your problem will get smaller, and you will be able to solve the problem one by one, right? So the point is, think about, you have sold this land and building. In this transaction, in this exchange of asset, what is happening? You are purchasing an asset and you are selling an asset. यही तो कर रहे हो. But you are settling in net. That's all. So you are selling 10 million asset at 15 million, and now you have 15 million rupees, and you have 3 million rupees already. So now you are going to the dealer Airbus, and you said Airbus that Airbus, I have carried 18 million rupees, give me the aircraft. Value of the aircraft is 20 million, but he has taken 18 million. So why he has taken 18 million? Because he has given you 10% discount. डिस्काउंट दिया है ना, और क्या किया है?
Yes, sir. From 20 million, they reduced and they given to 18 million. 2
18
million is a discount.
So for Airbus, the aircraft manufacturer, 18 million is the revenue from operation. Remember Ind AS 115, वहां भी मैंने आपको यही पढ़ाया है. ठीक है, वहां पर रेवेन्यू की साइड से मैंने आपको पता क्या पढ़ाया है? रेवेन्यू की साइड से मैंने आपको पढ़ाया है जो आपको द कंसिडरेशन विच यू आर रिसीविंग फ्रॉम द कस्टमर मींस द फेयर वैल्यू ऑफ द एसेट रिसीव्ड. ओके, दिस द लैंड एंड बिल्डिंग इज द कंसिडरेशन विच यू आर रिसीविंग एज अ सप्लायर, राइट? और यहां पर क्या पढ़ा रहा हूं? फेयर वैल्यू ऑफ द कंसिडरेशन गिवन अप. कैन यू बी एबल टू रिलेट दैट?
Yes, sir.
Yes, sir.
So, friends, in this case, what will the accounting entry? Private jet PP account debit 18 million, to cash 3 million, to land and building 10 million, which is WDV, which is carrying value, to profit on sale of land and building. I hope it is completely clear. Friends, these are the small concept, but if you will digress, if you will stay away from your focus, right? If your focus is not on your focus, then completely messed up, right? Very simple concept, very logical concept. You have to think logically that what I am acquiring a private jet, what I am paying land and building and cash. What is the fair value of land and building and cash? 15 and 3. That's all, right? But should I credit my land and building at 15? No, because my land and building is only 10. Then what is this 5? This 5 is profit on exchange of land and building, right? Is that clear or any doubt? Do you have
Yes, sir.
any doubt?
Clear.
Clear,
Clear,
sir.
sir. Crystal clear.
Crystal clear? Okay, very good. Very good. Friends, now we covered two important concepts. We covered two important concepts of what? We covered two important concepts, deferred payment credit and exchange of assets. Now, my dear friends, I have reached to measurement subsequent to initial recognition. Right, means measurement on the reporting date. So what are the two models which are given in the standard? And it was given in accounting standard also. Can you tell me what are the two models?
Cost model, revaluation model.
Cost model, revaluation model. Cost model and revaluation model. Right. Cost model, revaluation model. Have you heard about these models prior to Ind AS? Have you heard about these models prior to Ind AS?
Yes, sir. It was there in the earlier standard as well.
AS10 also.
It was there in
AS10.
It was there in AS10 also. It was there in AS10 also. Yes. And what is meant by cost model and what is meant by revaluation model? Anyone who wants to, anyone other than Saminathan? Other than Bibhu? Anyone who wants to tell me what is this, cost model and revaluation model? Mamta, you want to explain what is cost model and revaluation model?
So cost is when the asset was purchased at the first time. That would be the cost, total cost. And revaluation is done subsequently, and that is done at the fair market value, I think.
Okay. Yes. So you're right. So cost model means, all the PPs are initially measured at cost. Yes, this is what I told you, na? What is the initial measurement of PP?
Cost or to cost.
At cost. Initial measurement is at cost. Okay. So now coming to the subsequent measurement. So on the subsequent measurement, either you will carry your PP at cost, considering the original cost, or you will carry your PP at revaluation model. Okay. Means you will carry your PP at fair value, either at cost or at fair value. Okay. At cost or fair value. Right. So friends, let's discuss the meaning of cost model and revaluation model with the help of the examples. Initial recognition means recognition at transaction date. Subsequent to initial recognition means recognition after transaction date, that is reporting date. Means we are talking about measurement at reporting date. Okay. After that. Cost model means PP is carried at original cost. Right. So this standard talks about the carrying value. How to determine the carrying value on the reporting date. Right. And what is the formula of carrying value? This is not the new formula. If anyone can tell me what is the formula of carrying value?
Carrying value
minus accumulated depreciation minus accumulated impairment losses.
Cost minus accumulated depreciation
minus accumulated impairment loss.
Accumulated impairment losses. Okay. So are you aware about this concept, or you are able to speak when you are looking at this Excel file?
No, aware.
Aware. Okay. Very good. Very good. So carrying amount is cost minus accumulated depreciation minus accumulated impairment losses. For example, I have purchased a car for rupees 1 lakh. 10 lakh का एग्जाम्पल ले लेते हैं. 1 lakh तो अब सस्ता जमाना चला गया. Yes. So I have purchased a car for rupees 10 lakh. The life of the car is 10 years. What is the depreciation per annum? What is the depreciation per annum?
20.
No, 10 lakh rupees the value. 10 years is the life.
1 lakh.
1 lakh.
1 lakh. So cost minus depreciation. So what is my value at the end of the first year?
90,000.
9. So 10 lakh मैंने लिया था.
9 lakhs.
Sorry, 9 lakhs.
9 lakh. What is the value at the end of the second year?
It's 8 lakh.
8 lakhs.
What is the value third, fourth, fifth, sixth, seventh, eighth, and what is the value at the end of the 10th year?
0.
0. Means you have opted a cost model, right? What you are doing from the cost, you are reducing depreciation every year when the asset is getting used or the time is elapsed, right? So carrying amount is cost minus accumulated depreciation. Now coming back to a different scenario. In the first year, so when you purchase the car and when you completed the first year, the value of the car which you have purchased is 10 lakh rupees. 1 year has gone, you have charged depreciation of 1 lakh rupee. The first year end value is 9 lakh rupee, but the government has announced a ban of that car after 3 years. Let's say that the car will not run on the street of Delhi. The car can run all across India, but not in Delhi, right? Because of the change in the technology of engines. This is the negative news. Tell me whether the market value of the car will go down or not with
Yes.
this announcement.
Yes, sir.
Will go down.
Yes, sir. Go down.
So cost minus accumulated depreciation at the end of the first year, you are showing 9 lakh. And why you are depreciating, you have spent a cost of 10 lakh rupees. You will use the car for 10 years. Future economic benefit is for 10 years. You are assuming that when I charge 1 lakh rupees, my carrying value is largely equivalent to my market value, right? In the normal scenario. But in this case, after end of the first year, when government has come up with such an announcement, the market value of the car has drastically gone down. And at the end of the first year, if I will go and sell this car in Delhi's market, Karol Bagh में बेचने जाऊं, in that case, what happens in that case? The value will comes at 8.5 lakh. I will be able to sell it 8.5 lakh only. Or let's say 8 lakh only. The value will be 8 lakh only. So in this case, should I charge any impairment? Because
Yes.
my carrying value is higher than the recoverable value, and there is a concept in the accounting standards, in the Ind AS, that whenever your carrying value is higher than the recoverable value, you have to reduce it to the recoverable value, right? So what is the carrying value at the end of the first year in this scenario? 8 lakh?
8 lakh, sir.
8 lakh. So cost is 10 lakh minus accumulated depreciation for 1 year is 1 lakh, and accumulated impairment loss is also 1 lakh. So what is my carrying value at the end of the first year? 8 lakh.
8 lakh.
8 lakh. Now, remaining life. What is the remaining life?
9 years.
9 years. Because the car can be used for 9 years. Not in Delhi, but somewhere else. So, so what will be your next year depreciation? What will be next year depreciation? 1 lakh again?
No,
No,
sir. No.
it
Why
will
not?
be less than 1 lakh.
Because remaining year is 9 years. We have to 8 lakh divided by 9 years. It will come 88,888.
Yes, sir.
This is the area where not only student chartered accountants are also making mistake. What they do, so they always think that the depreciation is a calculation which is always happening on the recognition date. Always happening on the initial measurement date. No. Depreciation is a prospective calculation. And you know what is the value of the depreciation every year? The value of the depreciation every year is equal to carrying value divided by the remaining useful life. Carrying amount divided by the remaining useful life. What is my carrying amount at the end of the first year, Neha?
Sir, 8 lakh.
8 lakh. And Neha, what is the remaining useful life?
9 years.
What is the depreciation, Neha, in that second year?
Sir, 8 lakh divided by 9.
8 lakh divided by 9. Okay, this will give you, and let me give you the depreciation here. 8 lakh divided by 9. So your depreciation is 88,889 rupees. Okay. And what will be the carrying value at the end of the second year? What will be the carrying value at the end of the second year? क्या carrying value होगी? What will be the carrying value at the end of the second year?
7 lakhs 11,000. Triple
7
one.
lakh 7,000. So opening balance minus closing balance, or what is the carrying value at the end of the second year? What is the carrying value? क्या है carrying value? What was the cost? What was the cost? Minus accumulated depreciation minus accumulated impairment losses. What is the cost? 10 lakh rupees. Cost तो 10 lakh ही थी ना?
Yes, sir.
Minus. What is the accumulated depreciation for 2 years?
188.
188
889.
889 minus what is the accumulated impairment losses?
1 lakh.
1 lakh.
1 lakh. This is the carrying value, right? This is the carrying value. ठीक है? ठीक है
Yes.
नहीं है?
ठीक है सर.
Yes, sir.
Yes,
Okay.
sir.
Right? So friends, at the time of subsequent measurement on the reporting date, this standard talks about how you will determine the carrying value. And what is the carrying value? It's a cost minus accumulated depreciation minus accumulated impairment losses. So with the help of this car example, have you been able to appreciate how to arrive at the carrying value?
Yes, sir. Very much.
Have you understand that whenever you compute depreciation, your depreciation for that year is equal to the opening balance divided by remaining useful life? Opening balance divided by remaining useful life. If you will apply this formula, you will never be wrong in your practical life, in your student life, you will never be wrong. Because you know, what people understand and what even chartered accountant understand, they thought that पहले दिन जो depreciation निकाल दिया वो depreciation आपका हर साल चलेगा. So whatever depreciation you computed on day one, it will run forever. But this theory will fail. This theory will pass. Okay, I'm not saying that this theory will fail every time. But this theory will fail when? Tell me. When there is a impairment loss in between. When there is a impairment loss in between. Or when there is a revaluation model. If the company has opted a revaluation model, this theory will fail. When there is an impairment loss, this theory will fail. Okay. But one theory will always survive. Doesn't matter cost model, revaluation model, impairment. And what is that theory? Your depreciation for that year, for particular year, is equal to opening WDV divided by remaining useful life. Opening carrying amount divided by remaining useful life. Means, like in case of car, what is the opening carrying value at the beginning of the second year? 8
9
lakh.
lakh.
8 lakh था ना. 10 minus 1 minus 1. सेकेंड ईयर के ओपनिंग की बात कर रहा हूं. फर्स्ट ईयर का क्लोजिंग तो 8 लाख हो गया ना.
Yes, sir. Yes, sir.
Yeah. So the opening balance at the beginning of the second year, opening second year, कितना? 8 lakh.
8
Divide
lakh.
by remaining useful life. What is the remaining useful life when you are sitting at the beginning of the second year?
9 years.
9 years. Second year भी तो पूरा है. 9 years. Okay. Right. So this theory will always sustainable theory. This theory will always be a sustainable theory. Okay. ये आपको याद रहेगा. मैंने आपको बताया कि डेप्रीसिएशन कैसे कैसे निकालते हैं दो तरीके से, और मैंने बताया कहां पे गलती करते हैं. Yes. Okay. Yeah. Quickly let's see this also. The PP is carried at original cost. Carrying value is equal to cost minus accumulated depreciation minus accumulated impairment loss. For example, original cost is 1 lakh. Useful life is 5 years. Impairment loss at the end of second year is 5,000. Compute the carrying value PP in case the company has opted for cost model. So if the cost is 1 lakh rupee, depreciation for first year. How you compute depreciation for first year? In the beginning, the life is 5 year, remaining life. 20,000 is the depreciation, no impairment loss. This is the carrying value at the end of the first year. What is the remaining life at the end of the first year? What is the remaining life?
4 years.
4 years. So what is the depreciation for second year? 20,000. 80 divided by the. Can you see my calculation? Can you see how I have done the calculation?
Yes,
Yes,
sir.
sir.
So
Sir.
while the number is 20,000 only, but I have not picked this 20,000 from day one, from the first year. I have done the calculation. And what is my calculation? opening WDV divided by remaining useful life.
4 years.
4 years. Okay. Impairment loss, which is given in the question, is 5,000. So what is my carrying value at the end of the second year? 55,000. What is the remaining useful life? See,
3 years.
if my intent was right, my theory was right, then I will not get fail in this step, right? And you can see the same step I have applied, जो मैंने पहले apply किया था. Right? Okay. Then your carrying value at the end of third year, this much. Depreciation for fourth year, this much. This much is your depreciation for the fifth year. This is a carrying value. I hope this concept of cost model is clear to all of you. Very simple concept. Is it clear or clear? Is it clear in mind or clear from mind?
Clear in
Clear
mind.
in mind.
Clear in mind. Are you guys enjoying the class?
Yes, sir.
Very much,
Very
sir.
thanks, sir.
Are you finding
Yes,
FR
sir.
easy
Yes.
Yes,
or
sir.
complex?
We're actually becoming confident.
See, FR is a practical subject, right? FR is detail but not complex. FR detail hai because you guys are future ready, right? You will not be always a student. While by heart you will always be a student, but by your mind you will become a professional. You will become a professional. Okay. So FR is very detailed, but it is not complex. If you read and understand FR by heart, by logics, you will not be able to get fail not only in exam, even in your practical life. Right? Exam is a gateway to convert you from student to professional. But when you become a professional, every day you will give an exam in your company. Every day. Right? And if your fundamentals are clear, believe me, you will not get stuck anywhere. I am just a student like you guys. But the only difference is you are a student in 2025. I was student in 2006. That was the only difference. Okay. But I was also the student. Now I am heading a financial reporting vertical of a large listed company of having a balance sheet size of almost 1.2 lakh crore. Right. So again, I'm applying my concept of FR in the balance sheet, in the accounting, in the reporting. Same. So what you are doing on your notebook, I'm doing on the laptop. That's the only difference. Okay. Right? So FR is very simple. Believe me, very simple. I did self-study in my CA final curriculum, and even in CA intro also I did self-study, and I spent good 3-4 months complete 15-16 hour of study complete, right, with full dedication, full focus, right, and this is how I cracked FR with the flying marks. Okay.
Yes, sir.
So FR is very simple, but there is a underlying derivative. And what is the underlying derivative? You need to understand it logically. You have to do a lot of practice. You have to spend time and you have to remain focused, right? You should be aware how you should control the questions. And to control the question, you have to break the question into small parts, right? So whenever I explain you question, you see how I explain the question, right? So when I read the question, I also think about the question. Okay, yes, acha, essay, right? Okay, now come back to the revaluation model. And as explained by, I think Sanjay has explained that the revaluation model, the PPE has to be carried at fair value. Okay, means fair value on the revaluation date, fair value on the reporting date. So tell me one thing, if you are revaluing your PPE, in that case, whether for that year you will again charge depreciation on the revalued amount?
Yes, sir, of course.
No, sir.
No, my question is, Saminathan.
Okay.
Let's say at the end of the first year, I have opted for the revaluation model and I
Okay.
have revalued my PPE.
Okay.
So whatever is the value on the reporting date I got, which is a market value, should I again
Okay.
charge depreciation in the first year on that market value?
No, sir. From the next
Answer.
year only, answer is no. Next year we will do that
Yes,
depreciation for
of
that.
course, of course, of course, of course, yes. So next year I have to check the depreciation, I have to compute the depreciation. But for the first year, this closing value, this reporting date market value is there, that's a market value. Okay. So what is my carrying value? My carrying value is equal to revalued amount minus, see, what is the wording which is there? See, what is the word which is used? What is my carrying
Subsequent.
value? My carrying value is revalued amount minus subsequent,
Yeah.
right? Subsequent accumulated depreciation
And
minus
subsequent.
subsequent accumulated impairment loss minus subsequent accumulated impairment loss. Okay, means for the next years, not for this year, for the next years. Okay, minus subsequent accumulated impairment losses. So original cost is 1 lakh, useful life is 5 years. Okay, the company has revalued its PPE at the end of second year at 90,000. Let's solve this question now. Original cost is 1 lakh, useful life 5 years, same. The company has revalued its PP at the end of second year for 90,000 rupees. Impairment loss at the end of the third year is 5,000 rupees. Compute the carrying value PP in case the company has opted for revaluation model. Yes. What is my first year depreciation?
20,000.
Cost is
1
1
lakh
lakh.
divided by 5.
Remaining life 5 years. Depreciation first year 20,000. No impairment loss. Carrying value at the end of the first year 80,000. What is my second year depreciation?
20,000.
20,000. Impairment loss nothing. My carrying value is 60,000.
But
What is my
revaluation
revalued amount?
is 90,000, sir.
90,000. It means there is an upside of 30,000. There is an upside of 30,000 in this case. So what will be my carrying value? What will be my revised carrying value at the end of the second year? My revised carrying value will become
90,000 divided by
90,000. What is your accounting entry for this year, second year end? PP account debit to
revaluation surplus 30 ka.
revaluation surplus 30,000, right? Again, accounting standard concept. Now coming to the carrying value at the end of the third year. So carrying value at the end of second year is 90,000. Remaining life is 3. What is my depreciation for third year?
30,000.
30,000.
90,000 divided by 3.
90,000 divided by 3, 30,000. And the impairment loss is also given in the question at the end of year 3, 5,000. What is my carrying value at the end of the third year? 55,000. 90 minus 30 minus 5. What is the remaining value now? What is the remaining life?
2
2
years.
years.
What is my depreciation for fourth year? 27,500. Depreciation for fifth year, 27,500. Can you see? The depreciation was 20,000. When the revaluation happened, depreciation had changed. Can you see? When the impairment happened, the depreciation had changed. So, if you would have applied the theory that whatever is my depreciation in the beginning, 1 lakh divided by 5, 20,000 rupees I'll charge every year. So, don't you think this theory has failed 2 times in this question of 5 years?
Yes, sir, of course.
Yes, this theory has failed 2 times. Yeah.
Yes.
So if you would have applied a theory of opening balance divided by or closing balance of the last year divided by the remaining useful life, or opening balance of the current year divided by the remaining useful life, this theory will pass always. Yeah. This theory will pass always. Yes, I am telling you, this theory will pass always. Right. So why revaluation model should be adopted? Revaluation model should be adopted to show the actual picture or fair value of the asset at a particular point in time. Now the question comes, at what frequency revaluation is required to be done? Whether if you have opted for a revaluation model, whether you need to apply the revaluation model every year.
It depends on the.
If fair value is the increasing or decreasing dent on the particular asset, then we will do the every reporting year, sir.
So standard says that if there is a major volatility in the prices, means every year there is a major volatility, the prices are changing frequently, right? In that case, yes, you need to do the revaluation at every reporting date. But if there is no major volatility in the prices, then the revaluation at the interval of 3 to 5 years is sufficient. Means you have to do a revaluation at the interval of 3 to 5 years. That's all. At an interval of 3 to 5 years. Okay. Right. Okay. Clear?
Sir, carrying value at the end of second year 60,000 thi.
So carrying value, I have shown you the comparison to show you the this revaluation surplus entry. The carrying value after depreciation, it was 60,000. Then you need to compare the revaluation. Then you compare the market value, fair value. Okay. So
Sir,
the carrying value you can see.
sir, 90,000 means
revised.
recoverable amount होगी.
Sorry.
सर मतलब अगर मैं इसको आज मार्केट में सोल्ड करने जाऊं तो मेरे को 90,000 मिलेगा.
Yes, yes, yes.
So that is recoverable amount.
Yes.
So sir, recoverable amount is greater than carrying value.
Yes.
So impairment loss should be recognized.
नहीं. So if recoverable loss is greater than the carrying value, तो impairment loss कैसे होगा? Impairment loss तो आप अपनी carrying value पे देखते हो ना. There are two different aspects. Revaluation model क्या बोलता है? Revaluation model is saying you that you have to record your PPE at the fair value, right? That's all what revaluation model is saying. यही बताया ना मैंने आपको कि what is your revaluation model? Revaluation model says that the PPE is carried at fair value. Okay. So when you are computing a fair value, तो fair value ज्यादा भी हो सकती है, कम भी हो सकती है. The fair value could be high, could be low. Correct? If fair value is high, अगर fair value ज्यादा है, then what is the resultant output? If the fair value is high, like in this case, when I computed my carrying value, means cost minus accumulated depreciation, it was 60,000, but the fair value is 90,000. So I have recorded 90,000. Okay. But where the difference of 30,000 will go? Because fair value is ज़्यादा, fair value is higher. तो ये कहाँ जाएगा? 30,000 will go to revaluation surplus. But what happened if this fair value would have been 50,000? Then fair value means recoverable value would have been 50,000. Then
Revaluation loss of 10,000.
it was a revaluation loss. Nothing is called as a revaluation loss. It is a impairment loss. When there is a loss, it is nomenclated as an impairment loss. Okay. Right? So that is what it is, right?
Okay.
So when the value is decreasing, it is an impairment loss. When the value is increasing, it is a revaluation surplus. But to cut a long story short, when you have opted for a revaluation model, you are revaluing your asset. Then the outcome is the whether it could be a loss or it could be a gain, means surplus. Okay. If it is a surplus, it will go to revaluation surplus. If it is a loss, it will go to impairment loss, right? So this is what it is there. Yes. So friends, you have to do the revaluation at every reporting date if there is a major volatility in the prices. But if no volatility, then do the revaluation at the interval of 3 to 5 years, because this doing a revaluation, arriving at a market value, it's not a bookish exercise. You have to engage valuers for that. You have to pay price for that. Okay. Yes. Friends, now, sir, whether we will opt cost model, for example, we are having 5 kind of building, 5 building we are having. So we have 5 offices all across India. We have 5 buildings. So can we apply cost model to 2 buildings and revaluation model to 3 buildings? Can we do that?
No.
For 3 buildings, because the 3 buildings are located in the metro cities and the prices are shooting up like anything. So I want to apply revaluation model for 3 buildings, but I want to apply cost model for 2 buildings, right? So the question is, can I do that? The answer is no, I can't do that. Why? Then the question comes, why?
If you do that, then there will be inconsistency in that group of asset, class of asset.
Because the standard says that whenever you do whatever model you opt at the time of subsequent measurement, it has to be as per the class of the asset. Means you can apply cost model or revaluation model consistently to a class of asset. Yes. And what is meant by class of asset? Class of asset means a grouping of asset of a similar nature and use in an entity's operation. Similar nature and use in an entity's operations. Right? Similar nature and use in an entity's operation. Okay. Similar nature and use in an entity's operations. Like example of class of asset, office building, factory building, right? There are 5 buildings and 2 buildings are used for office purposes and 3 buildings are used for factory purposes, for manufacturing. Whether these 5 buildings are one class of asset or 2 class of assets.
2 class of asset, because the nature is different.
The building are building, but the nature and use in an entity's operation. In an entity's operation, the entity is using 2 buildings for the office purposes, administrative purposes, and 3 buildings for the depreciation purposes. Sorry, 3 buildings for the production purposes, manufacturing purposes, right? So when you go to the 2 buildings, you will find good fancy lights, neat and clean, no pollution, nothing. But when you went to the manufacturing setup, when you went to these buildings which are used as a factory building, will you find the same kind of shiny lights and shiny walls?
No, sir.
Of course
No,
not.
sir.
Of course, right? Because the first one is used for the operational purposes, for running the operations, for running the right offices, but the second one is later one is used for manufacturing, right? So if an entity wants to apply cost model to the office building and revaluation model to the factory building, then it is okay. Then no problem at all. Okay. So the company needs to apply cost model or revaluation model consistently to a class of asset. Class of asset means a grouping of asset of a similar nature and use in an entity's operations. Okay. Right. Example: office building, factory building, vehicles, machinery, furniture and fixture, office equipment, computer, aircraft, land, ships. Okay. Now, coming to the another example, a company has 5 office buildings, Delhi, Mumbai. The value is increasing and the company has opted revaluation model. For Jammu, Kanpur and Ludhiana, value is decreasing. So the company has opted for the cost model. Is this treatment right? Batao? Is
No,
this
sir.
treatment right or wrong?
Sir, wrong.
Wrong,
Why?
sir, because the nature,
Either cost model or revaluation model should be
yeah,
applied consistently.
the company has the office building. This is office building. It says similar type of asset, so it can use cost model or revaluation model based on
Whatever.
the whatever
Yes.
most appropriate way.
Yes. So whatever model the company can apply, but the company has to apply a single model, right? This is not right. The company has to apply a single model to the entire asset of a single class. Okay. Second example, the company has 4 buildings: Delhi, Mumbai, Jammu, Kanpur. Value is increasing for Delhi, Mumbai, value is decreasing for Jammu and Kanpur. But the Delhi, Mumbai building is for office purposes. Jammu, Kanpur is factory, right? So a company has opted a revaluation model for Delhi, Mumbai, but cost model for Jammu, Kanpur. Is this treatment right?
Right, sir.
Yes, sir, right.
Sir.
Yes. There are 2 class of assets: office building, factory building. For office building, revaluation model. factory building cost model. In this case, the company has applied a single model for all the assets of a particular class, and hence it is right, right? So in Ind AS, the cherry picking choice is over. There is no cherry picking choice, right? Whatever model you are applying, please apply consistently to all the assets of a particular class, to all the assets of a particular class, right? I hope it is clear. Yes.
Clear, sir.
Right. So measurement subsequent to initial recognition, the company can choose either cost model or revaluation model as its accounting policy. Accounting policy should be applied to the whole of a class of PPE and not merely to individual asset within a class. This is the formula. Revaluation model, after initial recognition, PP to be carried at revalued amount being its fair value at the revaluation date. Right? If a single item of PP is revalued, then the entire class of PP to which that asset belong, that item belongs, should be revalued. Class of asset means a grouping of asset of a similar nature and use in an entity's operations. Okay. A revaluation model. Valuation need not to be performed every year at every reporting date. It has to be at sufficient regularity so that the carrying amount does not differ materially from the fair value. Where movement in fair value are volatile and significant, then frequent revaluation. Otherwise, every 3 to 5 year revaluation is more than sufficient. You remember? That is why that concept of carrying value is cost minus subsequent accumulated depreciation and subsequent accumulated impairment losses given, because when you have opted for a revaluation model and you are also revaluing in 5 years. So what you will do in the remaining 3-4 years, what you will do in the intervening period, you will depreciate. आप depreciation ही charge करते रहोगे ना?
Yes, sir.
Okay.
Yes, sir.
Yes. So now, friends, we have arrived to revaluation gains and losses. What happens when there is a revaluation gain and revaluation loss, right? So it's 8:28 now. Let's have a 12 minutes break. We will start at 8:40. Okay. Right. And then we will cover revaluation gains and losses concept. We will cover the utilization of revaluation surplus concept, and then we will cover depreciation concept, and then we will cover derecognition concept. Okay. And then we will conclude this session for today. Okay. Yeah. So let's have a 12 minutes break and we will start at 8:40. So now coming to the revaluation model outcome, right? So when you revalue, what will happen? Either your value will increase or value will decrease, correct? So when your value will increase, for example, the carrying value was 1 lakh rupee, it has become, the carrying value was 1 lakh rupee, but it has become, let's say, 1,20,000 rupees. So 20,000 rupees value has increased. 20,000 rupees value has increased. So in that case, what will happen? It will go to revaluation surplus in other comprehensive income. You remember in my Ind AS 1, I have told you the concept of other income, right? So what is the accounting entry? Accounting entry is PP account debit to revaluation surplus. What happens when the carrying value of the asset was 1 lakh, it become 1,20,000 rupees, and 20,000 rupees you have credited to revaluation surplus. In the next year, there is a revaluation loss. There is an impairment loss of 15,000 rupees. So initially there was an increase in the value of the asset. In the next year, there is a decrease in the value of the asset. So what is the accounting treatment in case of decrease in the value of the asset? What is the accounting treatment in case of decrease in
The
the value?
revaluation surplus to PP.
Yes. So whatever is the decrease, whatever is the impairment loss, it has to be adjusted from the revaluation surplus. Okay. So
Yeah, to the extent.
Yeah. So this loss, this subsequent decrease has to be adjusted from whatever surplus it is available. So revaluation surplus account debit to PP account. Okay. Friends, and instead of subsequent decrease, let's say in the first year there is an increase. In the second year there is also increase. Then from 120 it becomes 130. Then
again we will credit to revaluation reserve.
Then again you will debit your PP and credit revaluation reserve OCI. Credit revaluation reserve OCI. Again you will credit revaluation reserve OCI, right? Friends, what happens when first time you are doing a revaluation? And there is a decrease. First time there is a decrease. So like here, first time there was increase, then subsequently there was an increase. So it will again go to revaluation surplus, decrease, then first adjust from revaluation reserve, and then excess will go to P&L, right? So first time you have done a revaluation and there is a decrease in the value. So the carrying value was 1 lakh, and when you have done the revaluation, it become 90,000. Where the decrease will go?
Profit and loss account.
Profit and loss account. The decrease will go to P&L. And first time when you have done, there was a decrease, but subsequently there is an increase. Then
First adjust with P&L,
then again, whatever decrease you have captured, whatever decrease you have recorded earlier, to that extent, you have to reverse your P&L, right? So when there was a decrease, 10,000 you debited to impairment loss in P&L, you credit your P&L, okay? And if there is a increase beyond decrease, then the extra portion will go to revaluation surplus OCI. First time there was a decrease, and subsequently again there is a decrease, then
same
P&L only.
account.
Yeah, we will
again it will go to impairment loss in the P&L account. So let's understand this entire chain with the help of an example. Okay, with the help of an example. Revaluation gains and losses. Example: building was purchased on 1st April 19 for rupees 10 lakhs. On 31st March 20, the value has gone up to 12 lakhs. It means gone up by 2 lakhs. On 31st March 21, the value has been decreased and gone down to 9 lakhs. Okay. Gone down to 9 lakhs. So on 1st April 19, it was purchased for 10 lakh, right? It is increased by 2 lakhs. It becomes 12 lakhs. Okay. So then after 1 year, it is decreased by 3 lakhs. It becomes 9 lakhs. Correct? So what is the
Right.
accounting entry? And the company has opted for revaluation model. Tell me quickly, what is the accounting entry in this scenario with
EP
the
to
given
revaluation,
information?
EP to revaluation surplus in the first year.
Building PP account debit to revaluation surplus by 2 lakhs, correct?
Yes.
And what is the accounting entry on 31st March 21?
Sir, we will debit to revaluation reserve OC account debit 2 lakhs, impairment loss 1 lakh, and the PP is 3 lakhs.
So we will whatever. So the revaluation surplus was 2 lakh. The decrease is 3 lakh. So revaluation surplus will debit 2 lakh. Impairment loss will debit 1 lakh. Building PP will credit by 3 lakh. Right? Building PP will credit by 3 lakh. Okay. Right. Yes. Whether this is clear to everyone? So to the extent of revaluation surplus available, what we have done, we have reversed the revaluation surplus, and since the decrease was beyond increase, so the additional loss will go to impairment loss and building account has been credited. Whether the left side is clear to everyone?
Yes, sir.
Can I please have a confirmation from every student?
Yes, sir. Yes, sir.
Okay. So now let's go to the right side. Case 2. On 1st April 19, the building was purchased for 10 lakh. On 31st March 20, the value has gone down to 7 lakh. On 31st March 21, the value has gone up by 11 lakh, gone up to 11 lakh. So on 1st April 19, building was purchased. It was decreased by 3 lakh. It becomes 7 lakh. Now it has increased by 4 lakh. It become 11 lakh, right? Okay. So the company has opted for revaluation model. 31st March 20, impairment loss P&L account debit to building PP. Okay. 31st March 21, building PP account debit 4 lakh. Tell me by which value this impairment loss will be reversed. So initially there was a decrease, now there is an increase. So whatever decrease you have recorded, reverse that. Simple. To impairment loss reversal in P&L. This will go to P&L. Okay. Impairment loss reversal in P&L. In P&L. Okay. Credit. To revaluation surplus OCI credit 1 lakh. Right. So this is how this revaluation surplus treatment has to happen. This loss has to go to P&L. This surplus has to go to OCI, because loss is a normal impairment loss, right? It's about a normal principle, regular principle. I hope this revaluation surplus part is clear to everyone. Yeah.
Yes, sir.
Now coming to the utilization of revaluation surplus, friends. Now let's say you have a revaluation surplus. Okay. So you have recorded.
Sir, in revaluation of assets, can we adjust the revaluation surplus or RR with inter asset or a class of inter asset? Can we do that?
So are you saying, for example, there are two buildings. On both the building, I have opted for a revaluation model, right? Yes. So, and on the one building, I have a revaluation surplus. On the another building, I have a impairment loss, right?
Yes.
So can I adjust my impairment loss on one building with the revaluation surplus of the other building?
Yes.
No, sir. We cannot do so. It has to be looked at independently.
So we cannot do so, right? So basically, revaluation surplus or impairment loss adjustment has to be seen on a particular asset level, not on a class of asset level. Okay.
Okay.
Please mute yourself. I don't know your name. Akshay, I think. Akshay, right? Yes.
Yes, sir.
Yes. Now coming to the revaluation surplus utilization. For example, let's say a company has a building and the value of the building the carrying value is, let's say, 1 crore rupees. And the company has done the revaluation, and the company has recorded this building at 1.5 crore. 50 lakh rupees is the impact of the revaluation surplus. After 6 months, the company has sold the building. And at the time of sale, this revaluation surplus was sitting in the other comprehensive income. This revaluation surplus, revaluation reserve was sitting after 6 months. So now the question is, what is the treatment of this revaluation surplus? The building has been sold. Tell me, what should be the treatment of this revaluation surplus? This revaluation surplus is also required to be reversed now?
Yes, sir. It has to be moved to retained earning.
Yes. So standard says that the provision is now this revaluation reserve has become a free reserve. Why? Because the asset has been sold. The money has been received. Asset has been sold. So standard says that in this case, this revaluation surplus will directly transfer to the retained earnings. It will be directly transferred to the retained earnings. My dear friends, at the time of disposal or derecognition of asset, the balance of revaluation surplus will transfer to retained earnings. Revaluation surplus account debit to retained earnings account. For example, A Limited has revalued its building on which revaluation surplus comes out to rupees 10 lakhs. The company has sold the building in the next year. What is the treatment of revaluation surplus on the date of the sale? Revaluation surplus will be transferred to retained earning at the time of derecognition. Revaluation surplus account debit to retained earnings account. And of course, for the building entry, building will be credited, the net block will be credited, and bank will be debited. Profit and loss will be recorded on the sale, right? But this entry will be revaluation surplus to retained earnings, right? Now, sir, what happened if I haven't sold the asset? I have the revaluation surplus and I'm using the asset for the lifetime. For the lifetime means whatever is the useful life of the asset, I will use the asset. Whatever is the useful life of the asset. So during the life of the asset, standard says that the revaluation surplus can be utilized every year to the extent of extra depreciation. To the extent of extra depreciation. You remember, in our revaluation model, we have done a question where the revaluation was there. The asset has become 90,000 from 60,000. And your depreciation was also become 30,000 from 20,000. देखा था ना आपने?
Yes, sir.
So before revaluation, your depreciation was 20,000. After revaluation, depreciation becomes 30,000. So how much is the extra depreciation? 10,000. So standard says that even you can utilize your revaluation surplus during the life of the asset as well. But the only thing is the revaluation surplus can be utilized only to the extent of extra depreciation. Extra depreciation means the depreciation which is coming out, due to
change in revaluation.
The depreciation which is coming out due to change in the value on account of revaluation. Okay, to that extent. But what will be the accounting entry? Standard says that whenever you will transfer your revaluation surplus, the transfer will always to retained earnings. It's a balance sheet to balance sheet entry. Revaluation surplus account debit to retained earnings account. Revaluation surplus account debit to retained earnings account. Right. Is that clear? Yeah. So example, life of the asset is 10 years. Cost is 1 lakh. Revalued amount is 1,40,000. So depreciation on the basis of original cost is 10,000. On the basis of revalued amount is 14,000. So what is my extra depreciation? 4,000. So this extra depreciation will go to the retained earnings every year. And this 14,000 will be charged to P&L. Right. So whatever is the total revised depreciation, that will be charged to P&L. But this extra depreciation will go to the retained earnings. Okay. Clear?
Yes, sir. I have one question, sir. The retained earning once moved to the extra depreciation to the retained earning, whether it is available for dividend, sir?
Yeah. The retained earning?
See, once the extra depreciation what we moved from the revaluation surplus
Yes,
to
it is available for dividend. Yes, it is
okay,
available.
fine. You're right, sir.
Because you are all see what you have done. You have debited this 4,000 to P&L also, na? Through P&L, your less profit is moving to the retained earning, right? So P&L
Right,
में
sir.
आपने उसको डेबिट भी तो किया है ना?
Right, sir.
Okay. So have you understood the concept of this revaluation surplus, revaluation gains and losses, impairment losses? So this question we have already covered in the Excel file, right? So this utilization revaluation surplus we have covered. Okay. So let me see if any question is there in the study material for this revaluation surplus. Do you want to do the question from the study material on the revaluation surplus? You want to do that?
Yes, sir.
Okay, so let's go to the study material. So let me find out the question from there. Yes, illustration number 4. Illustration number 4. Venus Limited is a large manufacturing group. It owns a considerable number of industrial buildings, such as factories and warehouses, and office building in several capital cities. The industrial buildings are located in industrial zones, whereas the office buildings are in central business district of the cities. Venus Limited management wants to apply Ind AS 16 revaluation model to subsequent measurement of the office building, but continue to apply the historical cost model to the industrial buildings. Analyze the accounting treatment to be applied by the management in the light of Ind AS 16. Is the Venus Limited doing the right thing? They are applying revaluation model to the office building, but they are applying cost model to the industrial buildings. So are they doing the right thing?
Yes, sir.
Why?
Because
They're different class of assets.
Because it's a different class of asset, because it is a different purpose and use in entities operation. Venus Limited management can apply revaluation model only to the office building. The office building can be clearly distinguished from the industrial building in terms of their function, nature, and their location. Ind AS 16 permit asset to be revalued on a class by class basis, right? So what the question is asking that on one asset we are applying, one class we are applying revaluation model, other class we are applying cost model. Is that okay? Yes, that is okay, right? Because there are two different class, number one. Number two, the model can be opted by class of asset, okay? So the different characteristics of the building enable them to be classified as different PPE classes. The different measurement models can therefore be applied to these classes for subsequent measurement. All properties within the class of office building must therefore be carried at revalued amount. Separate disclosure of two classes must be given in accordance para number 73. Okay. Right. Utilization of revaluation surplus. An item of PPE was purchased for rupees 9 lakh on 1st April 2001. Okay. It is estimated to have a useful life of 10 years and depreciated on a straight line basis. So what was the value? 9 lakh. Useful life is 10 year and depreciation is straight line basis. What is the depreciation per annum?
90,000.
90,000.
On 1st April 2003 means after 2 years. The asset is revalued to 9,60,000. The useful life remains unchanged as 10 years. Matlab useful life was the same which was the original life. Ignore impact of deferred tax, calculate depreciation and revaluation surplus for 2003-4 as per Ind AS 16. Friends, First of all, what was the actual value of the PPE?
9 lakhs,
What was the depreciation?
90,000
90,000 is the depreciation. Okay.
per annum.
So 90,000 is the depreciation per annum. So depreciation for this asset was purchased on 1st April 2001. So depreciation for 1-2 is 90,000. Depreciation for 2-3 is 90,000. Depreciation for 3-4 is 90,000, right? Assuming nothing has happened. So depreciation for 3-4 based on the historical cost is 9 lakh divided by 10, 90,000. But on 1st April 2003, means after 2 years, this asset was revalued to 9 lakh 60,000. So what is the revised carrying value at the end of the second year or in the beginning of the third year? 9 lakh 60,000. What is the remaining useful life?
8 years.
8 years ना. 2 years have gone ना. First April 1 को परचेज किया था. 1st April 2, 1st April 3. 1st April 3 का रिवाइज कैरिंग वैल्यू है. Revalued amount है 1st April 3 का. So the revised useful life is 8 years. So 960 divided by 8 is 1,20,000. So 120 minus 90. Additional depreciation is 30,000. Additional depreciation is 30,000. So in the profit or loss for 2003-4, how much depreciation expense will charge? 1,20,000 depreciation expense will charge. In P&L, the entire amount will charge. But what will go to revaluation surplus?
Difference.
The revaluation surplus to retained earning will be 30,000. Okay. So the revaluation surplus will be, and how much is your revaluation surplus?
30,000.
So what is the carrying value at the end of the second year as per the normal cost model?
7,20,000.
9 lakh minus 90 minus 90. 9 lakh minus 180, 7,20,000. And what is the revalued amount? 960. So 960 minus 720 is your 2,40,000. Okay. Out of 2,40,000, 30,000 has been transferred to retained earnings. And how come it is computed? So 120 minus 90, 30. Okay. So 240 minus 30, in your 2004 balance sheet, your balance amount of revaluation surplus is the original amount on 1st April 2003 was 2,40,000. 30,000 has been adjusted on account of extra depreciation. 2,10,000 is the remaining balance of your revaluation surplus. Any doubt in this question or answer?
Sir, which means on the second year, we will debit PPE that 2,40,000 to revaluation reserve account, 2,40,000. Then on the end of the year, every year, we will 30,000 move from revaluation reserve to retained earning.
Yes.
Okay, sir, got it.
Neha, is it clear to you?
Yes, sir.
Manish, Akshay, Nitish?
Yes.
Okay.
Yeah.
Sir, which means from third year onwards, subsequent, not on the second year, 30,000 will be moved from
of course. Okay. Not from the second year, Saminathan. Even if you see the first year has gone, second year has gone, this revalued amount is on 1st April 2003, which is after 31st March, which is in the beginning of the third year, right? Which is in the beginning of the third year. Okay. So no change in the first year and the second year. In the first year and second year, if I'll ask you what is the carrying value of this asset at the end of the second year, it is cost 9 lakh minus accumulated depreciation 180. 720 is the carrying value at the end of the second year. And whatever is the carrying value, closing value at the second year, it will become the opening value of the third year, right? So against 720, the revalued amount is 960. So 240 by 240 on 1st April 2003, you will debit your PPE, you will credit your revaluation surplus OCI. Okay. And then at the end of the year, which is 31st March 2004, what you will do, whatever is the extra depreciation to that extent, you will debit your revaluation surplus and credit your retained earnings. Right. And whatever is the depreciation, you will charge entire depreciation in the P&L. You will charge entire depreciation in the P&L. Okay.
Right, sir. That is why we are calling this as a subsequent depreciation.
Yeah.
Sir, why don't we transfer 2,40,000 in the first year itself to revaluation surplus? when it is
First year
revalued.
means which
First
year?
year 20x3.
20x3. So 20x3 में ही तो कर रहे हैं. So 1st April 20x3. So if the financial year is April to March, right? So tell me, what is a financial year? It starts from April and it ends on March. What is the opening date of a financial year? 1st April 2000. 1st April. What is the closing date of a financial year? 31st March. So when you will charge depreciation, whether you will pass depreciation on day one or at the end of the year, at the end of the period. At the end ना.
Yes.
तो जब depreciation की entry pass करोगे उसके बाद ही तो उसको transfer करोगे ना.
Okay. Yes. Now got it. Yes.
Yeah.
Yes.
So once you pass that entry, depreciation entry, then only you will be able to know, okay, this is the extra depreciation I am passing, and then you will, to that extent, you will debit your revaluation surplus and credit your retained earning. While this is a balance sheet to balance sheet entry, and that that will be a P&L entry. What is a P&L entry? P&L entry will be your complete depreciation. Okay, that will be P&L entry. Depreciation. Right. Now, what is meant by depreciation? What is meant by depreciation? Tell me. Depreciation is a systematic allocation. Depreciation is a systematic allocation of depreciable value over the life of the asset. Depreciation is a systematic allocation of depreciable value over the life of the asset. Right? Depreciation is a systematic allocation of depreciable amount over the useful life of an asset. What is the depreciable amount? Let's say you have purchased an asset for rupees 1 lakh. Life is 10 years. So what is the depreciable amount in this case?
1 lakh.
1 lakh. If question says that you have purchased an asset for rupees 1 lakh, life is 10 years, residual value is 5%. What is your depreciable amount?
If we have to reduce the residual value.
5%.
So your depreciable amount is equal to original cost minus residual value. Original cost minus residual value, if any. Okay. In this case, 1 lakh will be my original cost and 5,000 will be my residual value. 1 lakh will be my original cost and 5 lakh will be my residual value. So my depreciable amount is 95,000 in this case. 95,000 in this case. Okay. Right. Okay. So now I need to allocate this 95,000 rupees on a systematic basis over the useful life. So 95,000 divided by 10, 9,500 is my 95,000 divided by 10, 9,500 is my depreciation. Okay. And depreciation should always be recognized as an expense in the P&L until and unless it is included in the carrying amount of the other asset. What does it mean? For example, I am using crane. For the purpose of constructing a building. Okay. So the crane is used for construction of a building. So crane is a PP. I will charge depreciation on crane. So where that depreciation will go?
P&L.
Crane.
That depreciation will be capitalized as a cost of the building, right? Because this crane is used for the construction of the building. So if an asset is used for the construction of another asset, then the depreciation on this asset will also be capitalized for the purpose of capitalization of that asset. Okay. So that is why it is written that depreciation should be recognized as an expense until and unless they are included in the carrying amount of another asset. Until and unless they are included in the carrying amount of another asset. Okay. Right.
So what about this? If this crane is used for multiple construction of more than one?
Then you need to allocate. Then you need to allocate on the basis of in the time proportion basis. For example, this crane was used for there are 4 projects which are going on. The crane is used for 3 months in the first project, 6 months in the second project, 1 month in the third project, 2 months in the fourth project. Then the yearly depreciation for the crane is 1 lakh rupee. So in the first project, the 1 lakh multiply by 3 divide by 12. Okay. So depreciation for 3 months has to be capitalized in the first project. Depreciation for 6 months has to be capitalized in the second project. 1 month in the third project and for 2 months in the fourth project. Right.
Right, sir.
Okay. So on a time proportion basis, sir, this crane is used for multiple projects, like 4 projects every day, then you have to estimate. You can use straight line apportionment basis also. You can use straight line allocation also, right? 25% on all the projects. Okay. But to cut a long story short, what is the intent? Standard says that depreciation should be recognized as an expense in the P&L until and unless it is included in the carrying value of another asset. Component approach. What is the component approach? Have we spoke about the component approach?
Yes, sir. We have discussed overhaul expenses, inspection
Major
expenses.
replacement, major overhaul, a major inspection where you are capitalizing the new component and you are derecognizing the old component. So what is a component? If an asset has a significant component with different useful life, then such component needs to be capitalized and depreciated separately in their respective useful life. Okay. If an asset has a significant component with different useful life, then such component needs to be capitalized and depreciated separately in their respective useful life. So friends, first of all, if there is a big asset, so there must be a significant component and it must have a different useful life to capitalize as a component. Right? For example, of componentization, in fixed asset register, there is a windmill, and it has a turbine generator other than turbine and generator, right? So the life of the turbine is 5 years, generator 8 years, other than above is 15 years. Okay. So this is the cost, this is the depreciation, this is the net block, and this is the total gross block, accumulated depreciation net block for the entire windmill. Second example, aircraft, Boeing. So which aircraft got crashed in a recent crash of Air India? AI 171 in Ahmedabad. Boeing aircraft. It was a Boeing aircraft, right? So aircraft Boeing, like it has an inspection component and other than inspection component, right? Inspection is a life of 5 years. Other than inspection component has a life of year 20 years. And it can also be allocated as an engine, major overhaul also. I'm just giving an example, right? So these are the known as a component approach. This is a component approach where the significant component have a different useful life, has to be depreciated separately. Okay. If there is a significant component, but the life is same, the life is, let's say, 20 years. So will we allocate or will we componentize that component? Answer is no. So if a significant component has a different useful life, then only you need to segregate the component. Otherwise, no. Depreciation. Now coming to the depreciation. What is meant by so whether depreciation will you charge depreciation when it is available for use or when it is put to use? What is the concept of depreciation?
Available for use.
Put to use is used in income tax.
Yes. The concept of put to use is used in Income Tax Act, but believe me, the concept of available for use is used in the company's accounts, in the Ind AS accounting standard. The concept is available for use. When I ask even chartered accountants, what is the concept of depreciation? Is it a put to use concept? Then everyone says that yes, it is a put to use concept. No, it is not a put to use concept. It is a available for use concept. It is a available for use concept. Okay. So you purchased a Honda City car, and who is you? Let me see. Akshay Agarwal has purchased a Honda City car, and he purchased the car, and on the day one he parked the car in his garage and he went to USA for the higher studies. He came back from USA after 6 months and nobody has used that car in his absence because He purchased that car for his own purposes, right? With a lot of love and affection, right? So he wanted to purchase that car for last 5 years, but now his dream has come true. But when his dream has come true, his another dream has called him to USA. He come back to India after 6 months and now he is starting using this car. So the car is put to use after 6 months, but the car was available for use before 6 months, right? So the depreciation will be started when this car was purchased. The depreciation will not start when the car will be taken for use. Okay, when the car is available for use, depreciation will begin, right? Depreciation has to be charged till point residual value is greater than or equal to carrying amount. Okay, so 1 lakh rupee is the cost, 5,000 is the residual value. So how much will be your depreciation? कितना depreciation होगा?
Sir, 5,000.
Residual value is 5,000 तो depreciation भी 5,000.
Sir, life क्या है asset की?
मैं पूछ रहा हूँ इस asset की पूरी life में what will be the total depreciation?
Nothing.
How much? Again, I am repeating my question.
95,000.
95,000. 1 lakh is the total cost of the asset. 5,000 is the residual value. So how much you will depreciate over this life? 1 lakh
95,000.
minus 5, 95,000.
Yes, sir.
So 95,000 is the total depreciation. Means your depreciation should not be greater than, right? So by charging a depreciation, it should not be negative. आपको depreciation कितना charge करना है? You have to charge the depreciation only to the extent of the fair value only to the extent the residual value will remain as a balance. Okay. Depreciation will be stopped when the asset is derecognized or held for sale under Ind AS 105. Okay. Depreciation has to be derecognized. Or depreciation has to be, sorry, not depreciation has to be derecognized. Depreciation has to be stopped when the asset is derecognized. So you have sold out the asset. Will you continue the depreciation?
No, sir.
क्या करते रहेंगे depreciation? Asset
No.
बेच चुके हैं. So depreciation, why you are charging depreciation? Depreciation is an outcome for a use, a flux of time, passage of time, use of the asset. When you are not using the asset, it is already, when you are not using means asset is not available for use to you. It has already been sold out. It has been derecognized. When the main asset is not there in the books of accounts, how will you depreciate? Or the asset is there in the books of accounts, but it is classified as a held for sale under Ind AS 105. In that case, also depreciation will not be recorded. Depreciation does not stop automatically when an asset is idle, right? For example, the demand has declined. Now you have pegged your asset and not using the asset. You will use the asset when the demand will pick up. For example, in case of woolen industry, in the summer season, the demand has declined in the summer season. So what they usually do, they pick up their sewing and stitching machinery. And they will open their machinery when the winter season will come or before 1 month before the winter season. So whether in the summer season, are they charging depreciation or they are not charging depreciation? Assuming it's a listed company, and they are publishing their results on a quarterly basis. बताओ depreciation का खर्चा लेंगे या नहीं लेंगे?
लेंगे
Yes.
sir.
लेंगे, because depreciation does not stop automatically when the asset is idle. Okay. Now, what are the methods of the depreciation? Tell me, what are the methods of the depreciation?
WDV and
Straight line, WDV.
and units of production method system.
Three method. Straight line method, written down value method, and unit of production method. It is also called as a unit of digit method or unit of production method, right? So friends, you charge depreciation over the useful life. And this depreciation method is depending on the future economic benefit. This depreciation method is depending on the future economic benefit. For example, if you are forcing your future economic benefit consistent, same throughout the life, what is the appropriate method which you will apply?
Straight line.
Straight line method, right? Friends, if you are expecting your future economic benefit should be higher in the initial years and it will again go lower and lower in the subsequent years.
Written down.
Written line.
Yeah,
Yeah, written down value method.
written down value method. Written down value method. Okay, because your depreciation will be higher in the initial years and your depreciation will be lower in the subsequent years. Okay, the depreciation will be lower in the subsequent years. Okay, so it will be written down value method. When your depreciation, when your future economic benefit depends on the usage, right? And let me tell you, for example, have you ever purchased a projector? Have you seen a projector? LED projector?
Yes, same.
Yes, sir.
Must have seen. You know LED projector? When you want to buy an LED projector from the market, and you will ask what is the life of the projector, right? So the vendor, the supplier, the shopkeeper, the company, they will not tell you the life is 10 years, the life is 5 years. No. They will tell you the life in the lamp hours. That this projector will run for 20,000 lamp hours. 20,000 lamp hours. Okay. So like aircraft, of course, aircraft has a life also, and they are also measured by flying hours. Their component capitalization, their major overhaul, replacement is also measured by flying hours. Okay. So friends, this projector, which is measured by lamp hours, means whenever you will use, you will get the benefit. Simple. So let's say the life of the projector is 10,000 lamp hours. And in the first year, you have not used the projector. Right. So what is the appropriate method of depreciation?
Units of production method.
Units of production method means whatever units you have consumed, whatever units you have used, to that extent you need to
Depreciate.
depreciate. To that extent you need to depreciate. Okay. Yes. To that extent you need to depreciate. Right. So friends, your method of depreciation depends on the future economic benefit. If the future economic benefit is consistent, you need to charge depreciation on straight line method. Equal depreciation will be there in every year. If impairment loss is not there and revaluation model is not opted, right? अगर revaluation model होगा तो क्या होगा? अगर revaluation surplus हुआ तो your depreciation will increase. अगर impairment loss हुआ तो your depreciation will decrease. Right? So equal depreciation. Since I have written equal depreciation, that is why I have given this extra caution here, because you will say that, sir, if I have opted for revaluation model, I'm not talking about cost model, revaluation model. I'm talking about the method of the depreciation. Okay. Reducing, if your future economic benefit trend is reducing trend, decreasing trend, then WDV method is appropriate method. Higher depreciation in initial years and lower depreciation in the subsequent years. On the basis of usage, then unit of production method, then your depreciation will also come in on the usage basis, right? Is that clear? Is that clear? So these are the depreciation method, right? Depreciation method adopted should reflect the pattern in which the asset future economic benefit expected to be consumed by the entity. If there is a significant change in the expected pattern of consumption, method of depreciation can also be changed in the subsequent years, right? In line with the future benefit. For example, my future economic benefit has a reducing trend in the first 3 years, but now it has stabilized. Now it has come with an equal trend. So now you have to convert from reducing to the equal. So SLM, WDV, sum of units method. So these are the 3 methods. Okay. Constant charge, diminishing charge, and the charge based on the expected output. Change in method is accounted for a change in accounting estimate. Okay. Change in method of depreciation is considered as a change in accounting estimate. Okay, it is not a change in policy. Always remember, at times student got confused. He thinks that only change in the life of the asset and change in the residual value is the change in estimate. No, change in method of depreciation is also considered as a change in estimate. Why? Because it is depending on the future economic benefit expectation. And if future economic benefit expectation is changing, it is like a change in accounting estimate. Okay. Right. Now let's discuss this illustration number 7 from ICAI study material. An entity acquired an asset 3 years ago at a cost of rupees 5 million. 5 million is equal to 50 lakhs. 3 years ago. Okay. The depreciation method adopted for the asset was 10% reducing balance method. So if the cost is 50 lakh, what is the first year depreciation?
It will be 55.
5 lakh. What is the WDV? What is the WDV?
45.
45 lakhs.
What is the second year depreciation?
4.5.
45, 4.5.
4 lakh 50,000.
I can see one of the lady student is trying to answer. So who is there? So I want her to answer.
Sir, 4,70,000.
4 lakh. So in the first year, cost was 50 lakh. So depreciation was 5 lakh. So WDV at the end of the first year is 45 lakh, right? 45 lakh. This is a reducing balance method, WDV method. So what is the depreciation in the second year?
4,50,000.
What is the closing balance? Means WDV at the end of the second year? 40 lakh 50,000. 40 lakh 50,000. Now what is the depreciation at the end of the third year?
4 lakh 5,000.
4 lakh 5,000. So 40 lakh 50 minus 4 lakh 5. What is the WDV at the end of the third year?
36 lakh 45,000.
45,000.
36 lakh 45,000. So 3 years ago, the cost was 50 lakh. The WDV at the end of the third year is 3655. Okay. At the end of year 3, the entity estimated that the remaining useful life of the asset is 8 years. 8 years. Okay. And they determined to adopt straight line method from the date so as to reflect the revised estimated pattern of recovery of economic benefit. At the end of the third year, they have estimated the remaining useful life to 8 years. What is the fourth year depreciation?
4 lakh 55,625.
How you have computed that?
36 lakh 45,000.
Yes, divided by?
Divided by 8.
Divided by 8. Very good. Right? So whatever is that, what I have told you, the opening balance divided by the carrying value divided by the remaining useful life. 3645 is the 3645 is the carrying value, and from year 4 to 11 your depreciation is 3645 divided by 8, 455,625. Okay, right? This is the answer, and this is the calculation. WDV at the end of the third year, and this has to be divided by 8. Okay, so this will be your annual depreciation. How much was the answer? 455, 625.
4 lakh 55,625.
Yes, this is the answer. Okay. Now change in estimated and residual value. Standard says that you need to see the useful life and residual value at the end of every year. You need to re-estimate. You need to see whether my useful life has changed, whether my residual value has changed. You need to estimate every year. Okay. If there is any change, then change in useful life, residual value, it will be treated as a change in accounting. What?
Estimates.
What is your estimate? Change in accounting estimate. And it has to be applied retrospectively or prospectively?
Prospectively.
Prospectively. You are not required to change your comparative, restate your comparative, provide the third balance sheet. No. You have to treat this as a change in accounting estimate, and you have to apply this prospectively. Okay. Future annual depreciation will be revised basis the new useful life. Future annual depreciation will be revised basis the new useful life. Okay. Correct. Now let's discuss this illustration number 12 of ICAI study material. XYZ Limited purchased an asset on 1st January for rupees 1 lakh. And the asset has an estimated useful life of 10 years and residual value of 0. What is the per annum depreciation?
Sir, 10,000.
10,000. The company had charged depreciation using the straight line method at 10,000 rupees per annum. On 1st January 2004, the management of XYZ Limited reviews the estimated life and decide that asset will probably be useful for further 4 years. And therefore, the total life is revised to 8 years. So first of all, on 1st January 2004, this change is happening. So up to 31st December 2003, 1st January 2004 से पहले की डेट कौन सी होगी?
31st December.
31st December 2003, right?
Yes.
So how much year has been completed for this asset?
3 years.
Sir, 4 years, sir.
1, 2, 3, 4.
Four
Sir,
years.
4 years.
4 years. 4
4
years.
years.
4
complete.
years. This is not April to March. This is January to December. 2000, 2001, 2002, 2003. 4 years. So 1 lakh was the cost. SLM method, 10-year life. What was the total accumulated depreciation? 4 years
40,000.
ka? 40,000.
40,000.
What is the carrying value on 31st December 2003?
60,000.
Original
60,000.
cost minus accumulated depreciation, 1 lakh minus 40, 60,000. What is the opening balance on 1st January 2004?
60,000.
60,000.
The carry forward has been brought down, right? The last year closing balance will become this year opening balance 60,000. What is the remaining life? What is the remaining
4 years.
revised life?
4 years.
4 years.
4 years.
4 years.
So this 60,000 has to be depreciated over
4
the
years.
revised
4
life.
years.
4
4
years. What is the per annum depreciation?
15,000.
15,000 is the per annum depreciation. Okay. 15,000 is the per annum depreciation. Right?
Yes, sir.
Yes. So friends, this was the concept of depreciation. This was the concept of depreciation. Now coming to the retirement and disposals. What is retirement and disposals? Friends, standard says that the carrying amount of an item of PP, the carrying amount of PP will be derecognized when it is disposed of, or when no future economic benefit is expected from its use or disposal, right? And whenever you have any amount of gain or loss, for example, if you have a gain, whether that gain will be revenue from operation or other income, the profit on sale of PP,
Other income.
because it is not in the capacity of selling in the ordinary course of business. It is not an ordinary activity. The bread and butter is not to sell the fixed asset. The bread and butter is to sell the inventory. Okay. So it also says that the gains shall not be classified as revenue. It has to be other income. Now you guys aware about Ind AS 115, you can understood the difference between the revenue, gains, income. Yes or no?
Yes, sir.
Yes, sir. If you wake up at the sleep, we can able to answer.
So, there is one person whose name was Alok Garg. He has taken 6 lectures on revenue from contract with the customer. And in the 6th lecture, at least 6 times, he has revised or he has talked about what is revenue, what is income, what is other income. Okay. Now, friends, the time has come for multiple choice question. If I talk about the difference between IFRS and Ind AS, in Ind AS 16, there is hardly any difference. There is no difference. But if I talk about difference between Ind AS and accounting standard, yes. So the concept of OCI does not exist. And hence, in accounting standard, revaluation surplus will be directly going to reserves, other reserves. जैसे retained earning है ना, वैसे reserves में directly चला जाता है. But here, it is routing through the statement of P&L, and in the statement of P&L, there is a section called other comprehensive income. So that's the only difference. Okay. Change in depreciation method is a change in policy, change in estimate, change in method, change in accounting standard. What is the right
Change in
answer?
accounting estimate.
B, sir. Estimate.
A change in accounting estimate.
What about others? Yes, it's a change in accounting estimate. It's a change in accounting estimate. It's a change in accounting estimate. Yes. So friends, answer B. It's a change in accounting estimate. When an asset is sold or disposed of, where is the gain or loss recognized? Asset disposal account, profit and loss account, asset disposal account, profit and loss account, revaluation reserve, or depreciation?
Profit and loss account, B.
Profit and loss, B.
Profit and loss. Answer is B. Under Ind AS 16, how often should the useful life of an asset be reviewed? At least at each financial year end, 6 months, management discretion, never.
At least each
At least
financial year
each
end.
financial year end.
At least at each financial year end, right? At least at each financial year end. Yes, at least at each financial year end. Yeah. I have told you, it has to be reviewed at each financial year end. Yes. Okay. Yeah. Then there's the slide of the. Yes. How should an item of PP be initially recognized in the financial statement? Nominal
Measured at
value, cost, net realizable value, what?
Measured at cost.
Measured at cost, B.
Measure at
Cost.
measure at cost, right? It has to be measured at cost. Okay. Answer is B. If one large asset has a number of individual components with different useful life, how should this be depreciated? Treat as one asset, break down into different components, expense it all, treat as one asset, and disclose in the notes to the financial statement.
Break down into different components.
Break down into different components.
Yes, sir. Answer B.
Break down into different components. Okay, break down into different components. Right. Okay, very good. Under Ind AS 16, which two subsequent accounting treatments are allowed subsequently to initial recognition? Cost model, PV model, cost model, revaluation model, fair value model, revaluation model, fair value model, cost model.
Cost model and
Cost model, revaluation model. You have told it many times, sir.
Answer is B. B is the right answer, correct?
Yes, sir.
B is the right answer. When it is dash, that future economic benefit associated with an asset will flow to the entity and the cost can be dash measured, it should be recognized as an S. What are the two conditions?
When it is probable.
It is a probable and reliable.
C.
Probable and reliable.
Probable
Answer
and reliable.
C.
C. C is the right answer, okay? And this is the recognition criteria, right?
And also cost should be measured. Measured.
Future economic benefit should be probable and cost can be measured reliably. This is the recognition criteria. Which of the following is not an asset that falls under the scope of Ind AS 16? Tangible asset. Asset held for production or supply of goods and services. Asset held for sale in the normal course of business. Asset expected to be used for more than 1 period.
Held for sale.
Let's see.
Sir, held for sale.
C. The A, C, and D is the definition of the PP. A, B, and D is the definition of the PP. C. Asset held for sale in the normal course of business is not come under the scope of Ind AS 16. It will come under inventory. When the revaluation model is used for PPE, the gain or loss should be included in where? Income for the period. Gain from revaluation on the income statement. A revaluation surplus account in OCI, an extraordinary gain or loss in the income statement.
Revaluation surplus account in OCI. Revaluation surplus account in OCI.
A revaluation surplus account in OCI, right? But if there is a loss, then
Profit and loss.
P&L. Impairment loss.
But let's say initially there was a gain, but subsequently there is a loss, then
First we will
adjust with revaluation reserve.
surplus account. Then
To the extent already
so
we recognized.
can you please speak one by one? So yes. So first I will allow to the one who is speaking less. Yes. Yeah. The student who are not very much engaging, I will allow them. Tell me, what happens if initially there was an increase, there is a gain, but now there is a loss subsequently?
revaluation surplus.
So first in the revaluation surplus, then when there is a loss,
Profit and loss.
You need to not profit and loss. If on
So
a
loss to
particular
the
asset,
extent of sir.
yes, if on a particular asset there is a revaluation surplus, subsequently there is a loss. So to the extent revaluation surplus is available, you need to adjust your loss from the revaluation surplus. If your loss is beyond the revaluation surplus available, then
Profit.
Then
Impairment loss.
revaluation surplus.
then the additional loss will go to the P&L as an impairment loss. Okay. If the loss is beyond the revaluation surplus, then revaluation surplus will be reversed and the extra loss, the excess loss will go to P&L as an impairment loss. Okay. Which of these is an allowable cost of an asset under Ind AS 16? Professional fee, general overhead, initial operating losses, administrative expenses.
Sir, answer A, professional fees.
Yes.
Please
Professional
tell me,
fees.
will you agree with him or not?
Yes, sir.
Yes.
Please participate. My dear friends, and believe me, I am not only a teacher, I am also a person from industry. If you have to grow in life, you have to speak. You have to speak for yourself, right? The more you engage, the more you will learn. The more you will learn, right? The more you will engage, the more you will learn. Believe me, right? I'm not saying you have to answer in every time, but at least try to engage. At least out of 5 questions, try to speak in 3 questions, right? Try to speak. I know you guys got the answer. I know at 90% times you guys are correct. But even if you are 10% time you are not correct, I will correct you. My job is to correct you, right? My job is to correct you. You guys are relying on me. I am
So yes,
teaching.
yes, sir. Either I will win or learn.
Yes. So my job is to correct you. My job is to take you on the track, right? You all are, when I'm teaching you, I'm not thinking that you know everything. When I'm teaching you, I'm teaching from the scratch. I'm giving small examples so that it will get printed in your mind. And it is not for a particular student. It is for the entire class who is attending on a live basis, and also the student who will watch this YouTube video in future, right? Because every student has a different capacity of a mind. Every student has a different learning ability and capability. So according to each and every student, I am taking that example. I'm taking that example. Okay. So then I'm elevating the level of example from a scratch to a complex level. Okay. Right. So please try to participate, engage, and answer. So believe me, you will enjoy. I'll also enjoy. Okay. I'll always appreciate more and more participation rather than the participation by only from 2-3 students, but not from the others. I'm not enjoying that. I am enjoying more and more participation, right? More and more participation. So friends, we have covered 10 multiple choice question. Now the Maggie time has come. What is meant by Maggie time? Quick revision. Okay. So let me revise this 2 complete classes with all of you. Stay tuned for the next 10 minutes. And in the next 10 minutes, I will revise the complete 2 classes. Okay. Friends, we started Ind AS 16. And in Ind AS 16, the title is Property, Plant and Equipment. So we discussed the definition of the property, plant and equipment, where we have discussed property, plant and equipment are tangible items which are held for use in production or supply of goods and services, or for rental purposes, or for administrative purposes, and the life is more than 1 year, or it is to be used for more than 1 period. Friends, land and building, if it is held for rental purposes, it is not a PP, it is an investment property under Ind AS 40. Right? Then we seen that when the company is doing any outflow or the company is incurring any expenditure, it will be treated as a PP if 2 criteria will be satisfied. Future economic benefits should be probable and cost can be measured reliably. If 2 criteria are satisfied, then you have to recognize the PP as an initial cost. Okay. So now the next part is subsequent cost. So what happens when you are incurring the cost subsequently? For example, major replacement cost, major overhaul cost, major inspection cost. Okay. So these costs are required to be capitalized right? And the old cost needs to be decapitalized. Why? Because it is meeting the definition of future economic benefit is probable and cost can be measured reliably. It is meeting the criteria. Okay, sir, but let's say, my day-to-day servicing cost is also meeting the same criteria. So whether it is considered as a PPE, whether it will be capitalized as a PPE, answer is no. It will not be capitalized as a PPE. Why? Because it's a day-to-day servicing cost, labor, consumable, it will charge to P&L. It is not a PPE. Okay, it will be charged to P&L. Okay. So, sir, if I know on the day one, for example, in case of aircraft, on the day one, I know I have to undergo a major inspection in every 5 years. Right. In that case, what should I do? In that case, you need to estimate what is my inspection cost today. Right. And that will be the component. Inspection component has to be depreciated separately over the period of 5 years. And the total value of aircraft minus whatever you have allocated to inspection. So the remaining value has been allocated to the other than inspection, means to the total aircraft, and the inspection component has to be shown separately. The total aircraft has to be depreciated over 20 years. Inspection component has to be depreciated over 5 years, so that in every 5 years the net block will become 0 and you need to recapitalize the new value again. So that is initial cost and subsequent cost. Then the third one is your measurement. So PPE has to be initially measured at cost. Cost means it includes purchase price plus import duty plus non-refundable taxes minus trade discount and rebates plus directly attributable cost plus initial estimated cost of dismantling and decommissioning or restoring. Directly attributable costs are those costs which can be avoided if the asset would not have been purchased. For example, handling, transportation, installation, technical fees, trainer fees, professional fees, testing fees, right? So these are the directly attributable costs. These costs are required to be capitalized as a part of the cost of the asset. The decommissioning and dismantling cost. So this is the cost which is going to be incurred at the end of the life of the asset. So we need to estimate what is the cost which we are going to incur. Then we need to discount it to the present value, and the present value of that cost is getting capitalized as a debit to the cost of the asset and credit to the provision for decommissioning obligation. And friends, this provision for decommissioning obligation, since it's a present value, the full value will come after 10, 20, 30 years. So the difference, this present value has to become a full value because you have converted full value to the present value. So now you have to convert present value to the full value. So how will you convert? By charging a interest cost, right? So finance cost debit to provision for decommissioning liability. I have also, whatever I'm explaining, I have given all the examples in the Excel file, in the PPT itself, right? Then friends, we have seen the concept of deferred payment term. If the asset is acquired on a deferred payment term, then in that case, you have to capitalize the PP at the normal cash price equivalent. Means when your total payment, the total payment made, the total consideration paid minus cash price equivalent is considered as a finance component, as a interest cost. Okay, it has to be shown in the P&L until and unless it will be treated as a borrowing cost and the asset is a qualifying asset. Then we discuss the concept of exchange of asset. In case of exchange of asset, when the asset is acquired in return of giving an asset, or in return of giving a combination of asset and the cash, in that case, if the exchange is in the similar kind of the goods and services, similar kind of asset, then the asset acquired is equal to the value of the asset given up, WDV of the asset given up. But if the asset has a commercial substance, there are two different assets. One, I'm purchasing a private jet and I'm giving a land and building. In that case, if fair value of both the assets are identifiable, asset acquired and asset given up, then your value of asset acquired is equal to your asset acquired will be measured at fair value of the asset given up. But if both the fair values are not given, only single fair value is given, let's say fair value of asset acquired is given, then whatever fair value is given, please use that value. Whatever fair value is identified, please use that value. Sir, if no fair value is identifiable, no fair value is given in the question, should we assume? Answer is no. In that case, your value of asset acquired is equal to WDV of the asset given up. Okay. Then friends, we discussed the subsequent measurement models. We discussed cost model and revaluation model. In cost model, you continue to carry at cost and you compute carrying value on the basis of cost minus accumulated depreciation minus accumulated impairment losses. And you need to compute the depreciation as a carrying amount divided by the remaining useful life. Okay. In revalued amount, you restate your asset at fair value. Every time you need to compute revaluation value, revalue your asset and compute fair value, right? And your carrying amount is equal to revalued amount minus subsequent accumulated depreciation minus subsequent accumulated impairment losses. You have to do the revaluation every year if the asset price is highly volatile, but if not, in that case, for example, you can make a policy. If the value of the asset is moving only by up to 10%, we will not do the revaluation. We will continue with what revaluation we have done. We will continue with that, right? So basically, it says that if the asset price is not highly volatile, you can do the revaluation at a frequency of 3 to 5 years. And then friends, the revaluation model or cost model, these model has to be adopted, has to be applied consistently by way of a class of asset. Okay. If you have applied a single model to a single class, you can apply a different model to a different class. Okay. But whatever model you are applying to an asset, you have to apply the same model to all the asset in a particular class. For example, office building, there are 5 office building and you are applying a revaluation model on one building. Please apply the revaluation model on all the 4 building also, right? All the remaining 4 building also, right? So class of asset means the nature and use of the asset in the entity's operation. If it is same, then it is known as a class of asset. Okay. And friends, then when you opted for a revaluation model, either there is a revaluation gain or revaluation loss. Revaluation gain is known as a revaluation surplus. Revaluation loss is known as an impairment loss, right? So whenever there's a revaluation surplus, it has to be, asset has to be debited and revaluation surplus OCI needs to be credited, right? Friends, if initially there is a revaluation surplus, subsequently there is a revaluation loss. In that case, whenever there is a revaluation loss, whatever revaluation surplus is available, your loss needs to be adjusted from the value of the revaluation surplus. If your loss is more than the available revaluation surplus, then the remaining loss has to be transferred to impairment loss in the P&L, has to be recorded as an impairment loss in the P&L. Sir, if first time there is a loss, it has to be recorded as an impairment loss in the P&L. Subsequently, there is a revaluation surplus. Then whatever loss you have recorded, you have to reverse that loss. Okay. And if the revaluation surplus is more than the loss, then whatever loss you have recorded, you have to reverse that loss in the P&L subsequently in the subsequent year, right? And if the revaluation surplus is beyond that, that extra has to be taken to the revaluation surplus OCI. Then we have arrived at the utilization of revaluation surplus. So revaluation surplus has to be utilized through retained earning. Doesn't matter when you are utilizing your revaluation surplus at the time of disposal of asset or at the time of continuity of the asset. The accounting entry will always be revaluation surplus account debit to retained earnings account. Okay. The only difference is in case of disposal or derecognition, at the time of derecognition, the revaluation surplus has to be transferred to the retained earnings. Okay. Completely. But in case of continuity of the asset, whatever is the revaluation surplus, every year to the extent of extra depreciation, that value you can transfer to the retained earning every year. Then we come to depreciation, and we understood depreciation is a systematic allocation of the depreciable amount over the useful life. Depreciation expense has to be charged to P&L until and unless that asset is used in the construction of another asset, then the depreciation of that asset has to be capitalized as a cost of this asset. Okay. So friends, the second part, depreciation has to be started when the asset is available for use, not put to use. Available for use concept is there, and depreciation is always used. Depreciation is always computed even when the asset is even when the asset is lying idle. Okay. So depreciation will be stopped when the asset is derecognized or when the asset is classified as held for sale. Friends, then we need to apply, for computing depreciation, we need to apply a method of depreciation. There are three methods of depreciation: SLM method, WDV method, unit of production method. And the method of depreciation depends on the expected future economic benefit. If the expected future economic benefit is consistent, straight line method is the most appropriate method. If the expected future economic benefit is reducing, then WDV method is more appropriate method. If the expected future economic benefit is on the basis of usage, unit of production method is more appropriate method. When the trend of future economic benefit is changing, you can also change your method of depreciation. And this change in method of depreciation has to be applied, has to be treated as a change in accounting estimate. It is not a change in accounting policy. It is a change in accounting estimate. Okay, friends, then you have to review your useful life and the residual value every year, at least once in the year, at least on the every reporting date. Whenever there is a change in useful life or change in residual value, it has to be treated as a change in accounting estimate. Okay, friends, then we discussed that this again, it has to be prospectively because it is a change in accounting estimate. Then the asset is the PP will be derecognized, right? It has to be derecognized when it is disposed of or it is sold. Okay, and if there is any profit or loss, if there is any gain, it has to go to other income. If there is a loss, it has to go to other expense, right? This is what the SAR, which we have covered in 5 hours and 45 minutes for Ind AS 16 PPE. So how did you like this 10, not 10 minutes, 12 minutes, 12, 13 minutes revision? How did you like that? I've covered every limbs and every arms of Ind AS 16. Yes. I hope you find it useful.
Like
Yes, sir,
very much.
useful. Rocket revision with in all the aspects.
Yeah. So thank you so much. God bless you. And please solve all the questions from ICAI study material. If you will find big questions, don't get confused, don't get scared. So as I told you, if you run with big problem, you will be in big problem, right? So break your problem into parts and you will get the solution. Okay, right. So thank you
So
so
there's
much.
a question about India.
There is a
Sir, what is there's a question about Indies. What is the kindly throw some light on this applicability of Indies on non-corporate entities?
the Ind AS on non-corporate entities, Ind AS is not applicable on non-corporate entities.
But just simply that only.
Yeah, because Ind AS has been notified under Companies Act. Companies Act,
Okay.
it is notified under Section 133 of the Companies Act 2013. Okay. Companies Act is applicable on corporate entities. And as per the notification dated 16 February 2015 and 30th March 2016, these are the two notifications which came for the applicability roadmap of Ind AS for Indian companies, right? So the roadmap has come only for the companies, not for the non-corporate entities. And hence, on the non-corporate entities, even the accounting standard notified by Companies Act are not applicable. Accounting standard issued by ICAI are applicable. Right? You understand now, for companies, if somebody will ask you which accounting standard you are following, which Ind AS you are following, your answer should not be that accounting standard which are issued by ICAI. For companies,
Okay.
accounting standard or Ind AS which are notified by Ministry of Corporate Affairs, right? It become law of the land. So for corporate entities, AS or Ind AS notified by MCA, issued by MCA. But for non-corporate entities, issued by ICAI, right? For non-corporate
Okay.
entities, Ind AS are not applicable.
Okay, sir. Okay. Actually, I've come back to study after 10, 12 years, so I'm little confused about that.
No problem. So not to worry if you are coming after 10, 12 years, people are coming back even after 25 years. And believe me, when you become a chartered accountant, so every day you will be a student.
Yes.
So never never be arrogant about that you become a professional, you become a chartered accountant. Feel proud about that, but never be arrogant about that, right? Because every day you will be learning, every day you will be a student. Even I am learning.
Okay.
If you will ask me, I am also learning FR. Okay. By teaching you FR, I'm also learning FR. Okay. So it's not
Okay,
that,
thank you, sir.
it's not that I'm 100%, Brahma of FR. No. Right. Even not I'm a Vishnu of FR. I'm not a Shankar of FR. I'm a teacher of FR. Okay. And I'm learning
Okay.
FR. Yes. Thank you so much. Stay blessed, stay happy, and please solve all the questions of ICAI study material. And have you got the Ind AS 115 material? Is it uploaded?
No, sir.
So Ajit ji, please can you check that? अजीत जी एक बार आप देखेंगे प्लीज, वो Ind AS 115 का स्टडी मटेरियल अपलोड करा दीजिए. Okay, I'll speak to Board of Studies and get it uploaded. Okay. Yeah. Thank you so
So
much.
एग्जाम पर्पज से एएस भी एप्लीकेबल होंगे हमारे एग्जाम में?
No. For CA final, only Ind AS will be applicable in your financial reporting syllabus. 95% of the syllabus is Ind AS. The 5% are other aspects, some other matlab not in accounting standard, like integrated reporting and some other stuff. But you can see, you can assume that 100% Ind AS, right? Ind AS only.
Okay.
Any other question? Okay, so if there is no question, so have a great day ahead. Thank you so much. Bye bye. Take care.
Thank you, sir.
Ashok ji,
Thank you.
session is
Thank
over.
you. Thank you, sir.